Equity trading session, expecting then to see a little bit of weakness coming through on these European stocks this morning. The FTSE 100 seems to be out the gates, down by just a fraction today. The dollar index, we've referenced the strength of yesterday, how that weighed on risk assets. Today looks a little bit different, but we've got the dollar gaining, in fact, looks a little more similar than it did just an hour ago. So the dollar continues to gain, the euro down 0.25%, the pound down by 0.2%. So the FTSE down 0.4% at the start of trading. This is the sovereign bond column that we were referencing on the back of those comments from Isabel Schnabel. This is the response we're seeing in markets, the 2, the 5. We also had the 10-year here earlier. Lots of different time horizons and lots of different geographies. We are seeing markets jump on those comments from Schnabel as if to suggest that we're done with the ECB hiking rates. And even if that was the market's assumption before those lines, interesting to see the market react to that. The French CAC 40 then down 0.1%. The Spanish IBEX, the Italian FTSE MIB a little more flat this morning. A little bit of weakness on commodities, but mixed actually when you look at what's going on with oil, which remains robust. Tom, what do you see on the sector picture?
Yeah, across these 12 main sectors then, every single sector now in the red. Financial services taking a hit, currently down 1%. You've got banks also lower by around 0.5%. The tech story is there, down at just 0.1%. Yes, there was the negative handover from the Nasdaq, of course, that closed lower by about 1%. And then we're seeing what's happening in terms of yields lower across the Treasury curve and here in the Eurozone, as Anna was highlighting for us. Energy is essentially flat as a sector. We're wearing up those comments, of course, from the Saudi energy minister, that determination to continue pushing ahead with those OPEC plus cuts. That is now just briefly turning into positive territory, just by the thinnest of margins. Personal consumption currently up 0.1%. Basic resources again in negative territory. This was a really big drag yesterday across the FTSE 100, currently down 0.4%. To the FTSE 100 then, you're seeing losses of 0.4, 7,482 across your European benchmark, a loss of just 0.1%. More data coming through, of course, and those comments from Isabel Schnabel effectively, and I'm paraphrasing, we are done in terms of further rate hikes, Anna.
Okay, so that's the sector picture. It certainly looks more red than green on the screen today. Let's bring in Sophia Holter-Acosta from the Markets Today blog, who can talk us through, again, some of the themes that they're dealing with on the blog. We've got some UK stories to talk about. We'll get to that on the shopping front. But let's go to the China story first, because this, as far as the global setting is concerned, is interesting. China's services sector maintaining its growth. So this is good news on China, but the market doesn't seem to want to listen to good news.
The market really doesn't. I mean, services is a much smaller chunk of the economy than manufacturing. So this is perhaps not the good news. It's good news, but perhaps not where the market was looking for. But essentially, it shows that there was a better than expected expansion. New orders grew at the fastest pace since August. The good news is that services is actually quite a big employer in China. So in terms of the jobs, the unemployment front that China is fighting, this is good news. The market reaction, though, I mean, the CSI 300, it closed at the weakest since February 2019. That is a very, very downbeat market. The Hang Seng China Enterprises Index, that's in Hong Kong, opened a little bit longer. Also a very bad day there, fell almost 2%. And actually, you saw the yuan weaken as well after those Moody's headlines. So really, really kind of negative sentiment in China. I don't think it's the economic data that will change change the picture. It's more kind of what China will do about it, and going forward, if there's any more stimulus coming, that's what the market's obsessed with.
And you talked to us earlier in the show about the challenges around pumping more stimulus into the economy in terms of the credit ratings. We've seen that, of course, from the Moody's downgrade to their outlook. The geopolitics, I wondered to what extent that is a factor across these markets as well, and how much that is baked in, because it's a reminder that you'd have been a fool to assume that after the two presidents met, everything was going to be fine, because the Chinese have come out and reacted quite negatively, it seems, to comments from Raimondo over in the US.
So, yes, Commerce Secretary Gina Raimondo, she just said, you know, we're not kind of backing down on these tech restrictions on China, and China is not our friend. Those are her words, and China reacting very negatively to that. So it really is, you know, even though Biden and Xi met for the first time in a year a month ago, it's really a reminder that there's so much work to be done for these two big powers, great economies, to you know, to be in the middle essentially, because those tech restrictions are still in place. There's still tensions over Taiwan, the military. You know, there was a U.S. military boat yesterday near those waters that China really did not like that at all. So, again, strong words from the foreign ministry saying that the U.S. should stick to the right perception and work with China, not say one thing and do another, Tom.
Right, yes. So Gina Raimondo saying that China is not America's friend, and China pushing back against those comments. Thank you very much. Thanks to Sophia Halter-Acosta from the Markets Today blog. You can get more from the blog team. You can go to the front page of the Bloomberg UK website to find the blog, or go to TLIV Go on the Bloomberg terminal. Let's check in once again on the bond market moves we've seen. This isn't pushing in the direction that the market had assumed, but interesting to see the market jump so convincingly on these comments from Isabel Schnabel around inflation and around rates. Schnabel saying further rate hikes are unlikely, and so we see yields on the 2-year French-German contract coming down substantially, down by more than 7 basis points. The Italian 5-year down by 7.5 basis points. You can see the 10 years also moving this morning. OK, here's what else we are watching today then. Throughout this morning, we're going to get final readings of European PMIs for November. Interesting, of course, in the context of those Schnabel comments that Anna was flagging for us at 10 a.m. UK time. We're going to get the Euro area PPI as well for October. Later, 3 p.m. UK time, watch for the JOLTS numbers for October. Potentially a tripping point, but see if those job openings continue to reduce. At the same time, we are due to get US ISM services data, and we know that data is important for many watching the markets and making expectations, building expectations around the Fed's next steps. And finally, this afternoon, we're going to be keeping an eye out for a rate decision from Kenya's central bank, Anna. OK, a lot in focus then. Coming up on the programme, Barclays drops after the top investor offloads almost half of its shares in the bank. This is the Qatar authority selling half of what it owns. It took that stake back in 2008. We'll get more in our Stocks on the Move segment next. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. Today, a special episode of Bloomberg Surveillance live from Apollo's headquarters. Join Tom, John, and Lisa for exclusive interviews with top leaders in finance, including Apollo's Mark Rowan and Jim Zelter, about the state of private markets, recession risk in the new year, and deal-making amid high interest rates. It's all happening today, starting at 6 a.m. Eastern on Bloomberg. Context changes everything.
This is Markets Today. We are just coming up to 10 minutes into our European trading session, and things actually turning a little more positive than they were at the start of trade, looking flat this morning on European stocks. US futures actually off earlier lows. NASDAQ futures were down around 0.6%, now down around half a percent. Yields continuing to move lower, in contrast to yesterday, seems to be the theme. Let us get a check on some of the individual stocks on the move. Joe Easton has a briefing for us. Joe.
So we've got Barclays shares coming down around 3% at the moment on that news of the Qataris selling around £500 million worth of stock. They are the second biggest shareholder, selling it at a discount. It priced at around 140 pence overnight. It's trading at 138, so trading below the price they were selling at. Some negative sentiment coming into that one following that big share sale overnight. And take a look at these telecom stocks on the screen here. We've got Ericsson jumping 9% and Nokia falling by the same amount. Quite surprising given there were big moves in these stocks yesterday. Ericsson winning the AT&T contract that Nokia previously had, and Nokia warning in a statement that this will mean they won't meet their margin targets for the medium term. We're seeing big moves across those two stocks this morning. We've got Ashtead as well over in the UK. This is machine rental, some weakness in their construction business, and also an overhang of the writers' strike when they did things like trailers for actors, that kind of thing. Their statement and the numbers there missing expectations this morning in an RNS release just a few moments ago. Then in terms of the real estate sector, there's an interesting note out this morning we're going to have a look at from Goldman Sachs. They do upgrade both Land Securities and British Land. Now, Land Securities was previously a sell-rated stock, but they've become more positive on the retail space. They say the UK consumer is actually holding up better than feared. Their economists don't expect a recession at the moment, and as such, they're seeing some strength in retail rents, and they upgrade British Land as well. They downgraded both of those stocks due to their exposure to the City of London offices, but it's all about retail, according to Goldman this morning. Vonovia is also in real estate. Now, this is in Germany, an interview with Bloomberg saying that they will be looking to sell some assets, potentially shoring up their balance sheet. That one is worth a read, and that one is rising following that exclusive interview there, up around 1% on the DAX index. Then we've got SSP. This is travel retail, it's food retail, upper crust. Everyone likes a cheeky upper crust at the station, don't they? That one is gaining 4%. Their sales are a little bit better than expected, was expected to be quite weak. Seeing some analysts raising their price targets on that one this morning. So that one's getting a boost here in London. Finally, on the last board, we have Moonpig. Moonpig shares up around 2%. I wanted to say Moonpig's flying, but it didn't quite work out, up 2% almost. So that one is also a sales update, a bit better than expected. I actually thought their outlook commentary was quite weak, but analysts seem to be looking past that one, potentially a bit of retail strength. In terms of some final broker moves, we've got a note out from JP Morgan. This is on medical tech. They say Carl Zeiss, which is eye care. It's
glasses, that kind of thing. They don't like that stock. They initiate at underweight on that one. They prefer EssilorLuxottica, which is exposed to sunglasses, which I think is a bit stronger. And there's a very, very negative note from Barclays on shipping, where they cut Hapag-Lloyd to underweight. They say this will be a very bad year, 2024, for shipping as rates come down. They've also got AP Moller-Maersk is underweight as well. Both of those stocks are sliding today. And a more positive note is on Capgemini, the big French IT firm. The price target raised at Citi. That's their favourite software stock, and that one's up around 2% in Paris.
Joe Easton from our equities team. Move over, cheeky Nando's. It's all about the cheeky upper crust, adding to our vernacular as ever. Joe Easton, thank you very much indeed. With us, some of the stocks on the move this Tuesday morning. Let's get back to the macro and at least how to navigate these markets, and bring in Hugh Gimber, Executive Director of Global Market Strategist at JP Morgan Asset Management. Hugh, I guess one of the central questions today, this week, this month, maybe this year, is does the Fed follow through on the cuts being priced in by these markets?
So our view is no, they don't, as quickly as markets are hoping. I mean, taking a step back, it is remarkable how quickly we've swung through different market narratives this year. So you start January, February, yields coming down, everything's slowing down, and then higher for longer dominates the summer. A big move in yields. Now it feels like we've gone full circle again. November, all markets trying to bring forward the timing of rate cuts. Now, I think when you go back to where the Fed's been over the past couple of years, we have just had a 10% inflation scare. They're telling you they are going to be data dependent. And to my mind, data dependent equals late, because it's saying we've lost faith in our models to be able to see where the economy is going to be in 6 or 12 months' time. Therefore, we want to wait to be absolutely confident the data is telling us the inflation scare is behind us. And therefore, I actually think that markets are likely over-egging how quickly the Fed are going to be able to cut. On the other side, there is room for them to cut further than is priced, which is, to my mind, what gives you support for bond yields over that 12 to 18-month horizon. But I feel that we've got a bit carried away here.
So the cuts won't come as soon as the market expects then, Hugh, in your view. And if they wait for the data, then they're late. So what's the disconnect, do you think, between... what's the lag, I guess, between when the data will get bad enough for the cuts versus where the market thinks the cuts will come?
Of course. So really the key area, I think, to watch is the labour market. And now normally in a typical late cycle pattern, you'd be thinking about the labour market as a very lagging indicator, right? It's normally the last to roll over. But if you have a central bank which is working on seeing the data first, the labour market is where we have to be focused. And so, yes, so far, things have been holding up okay. Wages still strong in particular. But we think there are starting to be signs now of cracks around the edges. So churn, for example, one area which has been slowing over the past couple of months, generally a good lead indicator for where wages may be headed. Because if you have fewer people moving around, it tends to be a bit less competitive. That'll be one area I'll be looking out for in the JOLTS report that comes out later this afternoon. The problem here is that it's a very normal pattern to be late cycle, the data to be holding up fine, everyone talking about soft landing, and then that animal spirits is what really starts to shift. So we think it's going to be very hard to time, but ultimately we're confident looking at a weaker economy in 2024 and ultimately weaker growth being a required element to bring that final mile of inflation back down to 2%.
Okay, so as we talk about the weaker economy, your projections for a weak economy in the US, some data crossing from the Eurozone, Spain in focus. These are final prints coming through in terms of November composite PMIs. For Spain, falling to 49.8, so in contractionary territory. The forecast had been actually to hold just above the expansionary line of 50.5, but the number comes through at 49.8. Services PMI falling to 51, still just about in expansionary territory, but a little below the forecast. So the lines there coming through for the November PMIs for Spain. And we've been talking about Isabel Schnabel's comments to Reuters around not expecting further hikes coming through from the ECB and the remarkable, quoting remarkable work that's been done on inflation. How are you thinking about where the ECB lines up in this whole debate?
Sure. So they're in a similar position in a way in that they still want to see further progress on wage growth. And we know that the Eurozone labour markets have been a little later to react as a result of greater unionisation. But ultimately, I think the ECB is more likely to turn more quickly because the growth data is just categorically weaker. I mean, we see it in the numbers there.
Is that turn in the first quarter, do you think, from the ECB?
I don't think so, no. Again, you know, markets pricing a first cut really by April. That feels still a little too soon. But I do think you look across Eurozone bond markets today, we see good opportunities to be locking in yields at current levels. I think there's a danger if you're thinking, okay, maybe they push back a month or two, then you run cash or short duration positions for too long. Ultimately, it's going to be very hard to time the peak, but we think there is compelling value locking in bond yields at today's levels across the Eurozone, across the UK, because if you wait too long, another couple of comments from Schnabel and her colleagues, and suddenly you've missed another opportunity.
Yeah, is it quite material that somebody like Schnabel should tell us something like that? The fact that, you know, in her view, further rate hikes are unlikely from somebody who previously might have lent towards more?
I think that's a really fair point. Now, let's be clear, it's not a surprise that rate hikes from here are off the table. That's been the expectation for some time, but it is a different voice at the ECB and generally one of the stronger voices within the Governing Council. So I think it's starting to demonstrate that as the concerns start to shift away from inflation on the back of that weaker print last week, you start then to think about growth. And it's when then growth rolls over next year and you then see the labour market weakening, you see services inflation coming down, that clears the way for rate cuts. So, as I say, I think there is a clear danger here that you try and be too precise in terms of picking out the peak in bond yields. We think now is the right time to be locking in.
Okay, so that's a really clear call in terms of locking in those yields across European sovereign debt. You're concerned about the economic prospects for the Eurozone. And what is the defensive play then within equities, Hugh?
Sure. So the starting point here is that you compare the rate cuts priced into the bond market versus still very optimistic earnings forecasts for next year. Both of those things cannot hold at the same time. So we see pressure on equity earnings ahead, particularly when you look under the surface at margins. Margins being assumed to hold at close to record levels in Europe, expected to expand again in the US, despite the fact that you're seeing inflation coming down and all of those positive aspects for margins over the past couple of years starting to turn. We'd be focused on income strategies in particular, whether it's the US, whether it's Europe. Dividends look well covered, payout ratios are low. Generally, you get an up in quality tilt with an income allocation as well. So those dividends we think will be well paid next year, a steady stream of income for equity allocations. I still think there's a bit more volatility ahead as analysts adjust those earnings numbers down.
Okay, Hugh, thanks very much. Thanks for joining us. Hugh Gimber, Executive Director of Global Market Strategy at JP Morgan Asset Management. We thank Hugh for his time. Coming up on the programme, more from COP28, including Mark Carney, Chair of Brookfield Asset Management and UN Special Envoy on Climate Action and Finance. That's next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
This is Markets Today. We're 23 minutes into your European trading day. European stocks actually pretty flat this morning after a lackluster start. US futures have been improving off lows a little bit during the last half hour or so. Now, Mark Carney, chair of Brookfield Asset Management and UN Special Envoy on Climate Action and Finance, spoke to Bloomberg's Francis Lacroix at the COP28 summit about the UAE's plan to put $30 billion into a new climate finance fund. Mark Carney is also the chair of Bloomberg Inc.'s board of directors.
So it's a wide range. So one of the focuses of this COP, as you know, is to triple renewable capacity. So think solar and wind and battery storage, conventional, if you will, renewable technology. That's been growing exponentially around the world. It needs to keep going. We see enormous opportunities in those regards. Just again, to bring it back to Brookfield for a moment, our deployment rate is about 7 gigawatts a year. So we're growing at 7 gigawatts. We already have over 30 gigawatts in operation. We have 140 gigawatts in our backlog. We're pushing that out. With respect to the emerging world, that new fund, we call it our Catalytic Transition Fund, so it's an emerging market, developing world focus. We've identified 6 gigawatts of projects already. 1.2 gigawatts will be deployed there. But that's just one of the opportunities. The other big opportunities, you say, where's the smart money going? The smart money now is rushing towards where the emissions are. So we're thinking heavy emission sectors, if I may. You know, so that's transportation, that's chemicals, that's steel, and it's getting those emissions down because you can come in at a low valuation, you're solving a big problem, and you're having both a high financial return, but for the planet, you're having a high emissions return as well because you're getting a lot of carbon out of the atmosphere.
But is there a danger that a lot... So we also have this loss and damage fund, which is basically transferring money to emerging markets. But I was looking at numbers of onshoring in the U.S. I mean, we're talking like millions of money going into the U.S., partly because of onshoring, partly because of the Inflation Reduction Act. So how does that change things?
Yeah, well, so loss and damage is dealing with a separate issue, if I can say. It's related to climate change, but it's the impact of what's happened historically. So it's an issue of global climate justice. It's not really an investment set of issues. But as you say, there are many things happening. And with the IRA, it is attracting a lot of capital into the United States. Look, the U.S. has to get emissions down as well. And the world will benefit from what's happening in the U.S. because it's driving down the cost curve for new technologies, hydrogen, carbon capture, and storage. I mean, these are existing technologies, but they haven't been commercial at large scale. The IRA benefit in the amount of capital, and we're very involved in this, amount of capital that's being deployed is going to lower the cost of those, just like the UK did for wind technology. The whole world benefits from that, as they will with the IRA.
That, of course, is Mark Carney, chair of Brookfield Asset Management and UN Special Envoy on Climate Action and Finance, also the chair of Bloomberg Inc.'s board of directors. Coming up, oil steadying after a 3-day loss. We're going to hear from Saudi Arabia's energy minister saying OPEC Plus cuts will be delivered. This is Bloomberg.
successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. Risk off. Markets reassess the likelihood of central bank rate cuts next year. European and US Treasury yields are lower. Barclays drops as Qatar's wealth fund offloads almost half of its shares in the bank. A surprise move as executives prepare a strategic overhaul for early next year. And oil steadies after a 3-day loss, as Saudi Arabia's energy minister tells us output cuts by OPEC Plus will be delivered in full and could be extended. We'll get more then, Tom, on that energy story shortly. The story in bond markets really about a return to the November theme of lower yields, and equity's not really sure what to do with that, it seems.
Yeah, the bond market story is far more interesting than the top line at Greece. The benchmark, the European benchmark, was currently flat, so the yields, as you're saying, Anna, sharply down across the curve. We focus, of course, on what's happening in Germany. Yields there down. The last time I checked, between 7 and 8 basis points on the 2s, and the 10s on the back of those comments from Isabel Schnabel that essentially we are done with rate hikes, coming through, of course, from that member of the ECB's board, and talking about the quote-unquote remarkable progress that's been done on inflation. So that has led to those moves lower in yields across European sovereign debt. But you lift the hood on the benchmark, and there are some individual corporate and sector stories that are much more interesting, whether that's the telecoms equipment space around Nokia and Ericsson and that AT&T deal, or indeed the real estate sector here in the UK. And we'll unpack those shortly. The DAX currently gaining 0.1%. So the German index in a different mood, it seems, a different sentiment coming through versus what's happening here in the UK. The FTSE 100 down 31 points, another down day for the FTSE 100, at least so far this session, off by 0.4%. So let's unpack some of those individual stories, some of those sector stories, and flip the board. It's basic resources that continues to be a drag on the FTSE 100 after the losses came through from that sector yesterday. Interesting in terms of the downside, 0.8%. Again, the China story in focus for today, including that outlook downgrade from Moody's. They're concerned about the fiscal health of that country as they try and shore up, policymakers, the economy. There is a price to be paid for that, and Moody's is reminding us of that. Basic resources, the concern about the Chinese economy, currently at that down 0.9%. Banks gaining, down 0.2%. Autos is up 0.1%. That's why you're seeing the DAX in positive territory. Industrial is also just about clinging on to gains. Energy up 0.4%. We've been speaking, of course, to the Saudi energy minister, and we can be unpacking that story for you in the next couple of minutes. The health sector is down 0.4%, and financial services taking a hit. Technology currently flat. We talked about telecoms, AT&T deciding to go with Ericsson over Nokia, and that story is playing out, and real estate as well. Some upgrades coming through from some of the real estate companies listed here in the UK, and a little bit of optimism there. But across your benchmark, you're flat. Over in Germany, a little bit of gain coming through, 16,418. But again, the FTSE 100, the laggard, down 0.4%. Anna.
Tom, let's talk about the energy markets then. Saudi Energy Minister Prince Abdulaziz bin Salman says oil supply cuts by OPEC Plus members can, quote, absolutely stay past the first quarter if needed. In an exclusive interview with Bloomberg, he pledged the curbs would be delivered in full.
I honestly believe that the best decision we made was to delay the meeting. I honestly believe that the delivery of the 2.2 will happen. I honestly believe that that 2.2 million will overcome even the usual inventory build that usually happen in the first quarter. I also believe that we wanted, it's almost we were working with a checklist. And that last item, that checklist, apart from the volume and the commitment and what have you, is to give the market a signal that these 2.2 million are not going to come the 1st of April. Simply because we wanted to market to know that there will be a phased-in approach. And since we don't know what would be the market situation, be it in January, February, March, we wanted to be careful about what language we use by saying it will be phased out or gradually, and it will be based on market condition.
So I ask you again, what did the market not understand about the deal? You took an extra week to get there. You brought everyone on board. Mm-hmm. The market seemed underwhelmed.
Well, not the market. The commentators that wanted the market not to believe the deal did their own work. They want to be conspiratorial, but I believe that a lot of credibility will be going down the drain when people see the reality of the deal. We also are not worried about, the jury is still out. But again, if you talk to Aramco, if you talk to ADNOC, if you talk to many of these companies, they see demand. They see that we're getting even a better prices than what we're getting as Brent is today.
Saudi Arabia's energy minister speaking exclusively to Bloomberg's Will Kennedy. For more on this story then, let's bring in Bloomberg's Matthew Martin in Riyadh. Matthew, talk to us about the market reaction then. Brent up 0.8%, still below $80 a barrel. Is this the reaction that Saudi Arabia would have been looking for, do you think?
Well, I think the short answer to that is probably no. I mean, clearly prices are not where the Saudis and the wider OPEC Plus group would like them to be. If you put on the sort of the broader context that we're in a period of very high geopolitical tensions in the Middle East at the moment with what's going on with the war in Israel and Gaza, we're starting to see attacks in some of the shipping routes which are traversing around this area. So given all of this tension in the region, given how deep some of these cuts have been, I think the response that they would have expected from the market and that they want from the market would have been much more dramatic. This sort of price is not where they want to see prices, and I think they want to keep hammering this message out, which they've been saying repeatedly recently, that demand is still very strong, but there's other people out there who don't understand the market fundamentals, which are the short sellers. They are keeping prices down, and so the Saudis and the wider OPEC Plus group, I think, are pinning their hopes on the fact that when we get into next year, we will see a significant rebound in demand, which will see prices spike. But obviously, all of that really depends on how much we see demand really come out in the way that they expect it to, given that there's a lot of concerns about global growth next year.
Yes, and given those concerns, how serious a concern is lower prices for Saudi Arabia, given how much it's spending on transforming its economy, trying to pivot away from oil, of course?
Yeah, well, exactly. I mean, this is becoming particularly acute for Saudi Arabia. If you look at the sorts of revenues that they get from oil exports on a monthly basis, it's high compared to historical standards. But, hardly a day goes by these days when we're not seeing the Saudis embarking on some big investment initiative, either outside the country through the Sovereign Wealth Fund or through big spending on diversifying the economy locally. So the oil price that the Saudis need to to balance the budget is much higher than it has been historically. Depending on which analysis you use and how much you sort of factor in sovereign wealth fund spending, it could be anywhere up to $100 a barrel or more. So clearly we're well shy of that now. We're getting to the point in, this is normally around the time of year when the Saudis announce the budget for 2024. So we're expecting to see that in the coming days, and we're expecting that to see, you know, continued deficits over the medium term, perhaps out as far as 2026. So the Saudis are watching this very, very carefully now, and will be very keen to see, to do what they can to push those prices up higher as they try and fund this big transformation program.
Matthew, thanks very much. Bloomberg's Matthew Martin in Riyadh with the latest on the energy story and how it's playing out regionally. Sticking with energy themes, US Special Envoy for Climate John Kerry says the dangers of climate change are monumental and the world is in uncharted territory. Kerry spoke to Bloomberg's head of Green, ESG and Equality, John Farrar, at COP28.
The dangers that we are facing, folks, and I am not an alarmist. I think most people know I've been pretty practical in trying to find solutions to challenges. But the dangers we face now are just monumental and even scary. And scientists are saying that. The best scientists in the world are saying what we face now is alarming, terrifying. These are quotes. And even we are in uncharted territory. Now, let me just say to you, it was 70 degrees Fahrenheit above normal in the Arctic last summer. It was 100 degrees Fahrenheit above normal in the Antarctic. And a massive ice sheet that has been tied up for, whatever, thousands of years, because it was so big and heavy, it was stuck in the mud, has now disappeared enough, melted enough that it floated, it's no longer stuck. It's moving out towards Georgia Island. It's going to melt. Just like 86 million metric tons of ice every single day in the Greenland. So we got to really decide, are we serious or are we fooling around with an existential issue? Existential. You hear that out of the mouths of sober politicians who are not playing politics, who really understand what's going on. So I do that as a preface because it has to be the guideline, the guidepost for everything we're thinking about and choosing to do. And the fact is, emissions are going up in too many places. And what the science says is, IPCC 2018, they could not have been more clear. They pointed the finger at all the people in positions of responsibility. You have 12 years within which to make the decisions and implement them, obviously, that will avoid the worst consequences of the climate crisis. That's science, mathematics, physics. And we're ignoring it in too many parts of the world. And so we're inviting the worst consequences. And we see what's happening. 18 $1 billion events in the U.S. climate events last year. 18 $1 billion separate events. Meanwhile, 30 million people displaced in Pakistan. Record fires in Greece and parts of the world. Come on. When do we get sort of, really focused on this?
All right, not mincing his words. That was US Special Envoy for Climate, John Kerry, speaking to Bloomberg's head of Green, ESG and Equality, John Farrar, at COP28. And that was in response, by the way, to a question for his response to the UAE and Saudi Arabia, saying they do not want to see a phase out of fossil fuels. Coming up, Vladimir Putin is reported to be heading to the UAE and Saudi Arabia this week. It is a trip abroad for the Russian leader and a rare trip abroad. More on that next. This is Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Happy Tuesday. This is Markets Today. 45 minutes into the European trading day. You're flat across the European benchmark. Stock 600, just a little lower, I should say, down close to 0.1%. But the action and the interest is really focused on what's happening in the debt markets, with yields falling and pretty pronounced across gilts here in the UK, but German debt as well, down 7 basis points on the 2-year after comments from Isabel Schnabel of the ECB that essentially the ECB is done, does not foresee further hikes from the European Central Bank. Let's get back to geopolitics now, though, and Bloomberg has learned that Russian President Vladimir Putin is travelling to the UAE and Saudi Arabia this week. The trip would be a rare overseas visit for Putin since Russia's invasion of Ukraine. For the context then, let's bring in Bloomberg's Bruce Einhorn. Bruce, talk us about that relationship then between Russia and these Gulf states.
Russia and the Gulf states are all members of OPEC+. Of course, a lot of cooperation among them when it comes to oil prices. We know that the Saudi energy minister, Prince Abdulaziz, yesterday told Bloomberg that there were some disagreements between Russia and Saudi Arabia when it came to production cuts. So presumably that will be an item high on the agenda when President Putin makes the trip to Saudi Arabia and to United Arab Emirates. It's our understanding that when he does go to the UAE, that will be after the COP conference ends, so not a high likelihood that he'll cross paths with John Kerry or any of the other leaders who have been attending that conference.
Okay, yes, just as we're talking about this, Bruce, we're getting confirmation from Interfax, the agency in Russia, that red headline across the Bloomberg terminal, that Putin is to visit the UAE and Saudi Arabia on December the 6th, this according to the Kremlin. So why now? And what is Putin signaling by taking this trip?
Well, Vladimir Putin is not able to travel to a lot of places. The International Criminal Court early this year issued an arrest warrant for him for alleged war crimes related to the war in Ukraine. And so as a result of that, there are a lot of countries that Putin can't go to. For instance, when the BRICS conference was held in South Africa earlier this year, President Putin didn't attend. He just was there remotely, did not attend the G20 conference in India. However, he has been traveling to friendly places recently. So there was a trip to China a few months ago. That was followed by a trip to Central Asia, including Kazakhstan. And so now there'll be this trip to Saudi Arabia and to United Emirates. So there are indications from this travel itinerary, from this schedule, that Putin does feel more comfortable these days going to some countries where he can have pretty good assurance that he's not going to be subject to that ICC arrest warrant.
Okay, Bruce, thanks very much. Bloomberg's Bruce Einhorn with a very timely update on Putin's travel plans. And just to recap, we're getting some further detail there. So Putin will visit the UAE and Saudi Arabia on December the 6th. We're also hearing from a different news agency, TASS in Russia, from the Kremlin, that Putin will be meeting with the Iranian president on December the 7th. Putin will be discussing oil market issues when he visits the UAE and Saudi Arabia, and also discussing Middle East issues. So the types of items on the agenda you would expect, I suppose. Tom, that's part of the geopolitical story this morning. Also a focus on China, though.
Yeah, this after, of course, Moody's changing the outlook, so downgrading the outlook for China's sovereign debt to negative from stable. And this is the context, this is a rationale from Moody's, reflecting evidence, rising evidence that financial support will be provided by the government and wider public sector to financially stressed regional and local governments. They're concerned about regional, local government debt piles as, of course, officials try to put a floor under the growth story there. And we've had a response from China as well, Anna.
Yeah, absolutely. China pushing back against this. I mean, most governments don't like it when anything is, and it's not a downgrade, but even an outlook is reduced. And China pushing back, as you would expect, saying the impact of the property market downturn on the budget is controllable. That's just one of the lines then, because clearly if the focus is going to be on the scale of the property market turmoil or local debt, they're also suggesting that the risks are mitigated there, saying that local debt, the scale is gradually declining and the risks are mitigated, saying the economy is long-term positive and fundamentals have not changed.
Indeed, economy to keep a positive trend in the fourth quarter. So the response there from Chinese officials to the downgrade, at least of the outlook from Moody's around China's sovereign debt.
Coming up on the programme, we'll get back to one of the UK corporates really making news this morning. Barclays drops after a top investor offloads almost half of its shares in the bank. We will get the details next. This is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
This is Markets Today, 8:52 here in London. European equity markets, a pretty mixed bag, actually, fairly flat overall, down just a touch on the Stocks 600. Let's talk about one of the stocks that is on the move this morning, and that is Barclays. Qatar's wealth fund is offloading almost half of its shares in Barclays, a surprise move that comes as the bank's executives ready a strategic overhaul for early next year. Let us get into this story then with Jenny Serrain, who leads our UK and Middle East finance coverage and joins us now on set here in London. Jenny, nice to have you with us. So what exactly has QIA decided to do with its really big stake in Barclays?
Yeah, so QIA is one of Barclays' largest shareholders, and they decided last night that they're going to offload about half of that stake. They offered it at a relatively small discount, but obviously investors are not happy, as you mentioned, because Barclays is down, more than 3% this morning on the news.
Yeah, down around that area quite now, and year to date down close to 10%, between 7.5% actually, to be completely accurate year to date for Barclays. But it's been a tough year for the bank. Talk to us about the timing of this announcement from QIA and why it's significant.
Yeah, it comes as a really big surprise. So early next year, executives have promised that they're going to deliver a big revamp in their strategy. They're supposed to outline that all in February. I think the hope is that that will really put them on this path to turning around the share price. And so the fact that QIA has decided to offload this big of a portion of its stake, just 2 months away from that big event, it's definitely surprising. I think that's why investors are probably feeling a little bit nervous this morning, because it just really is odd that they would decide to cut and run when they still have, so much more information left to be uncovered in February.
Yeah, absolutely. So February looms large, and they're not waiting for February, which I suppose is one of the messages that the market is receiving today. What does this mean then for the CEO of Barclays?
I just think it puts him under even more pressure. So CS Venkatakrishnan has been leading Barclays for a few years now. Obviously, as we said, the stock is down quite a bit this year. He already felt enough pressure to announce that they're going to be doing this big strategy revamp in February. But so, yeah, I think this just adds to even more pressure that he's under to really turn things around, get returns up, focus Barclays on the high returning businesses that it has. So I think we're just going to still see more of that to come.
Okay, Jenny, just very briefly, do you have any details, you and the team, about what to expect from that February restructuring?
So what we've reported so far is that they are, definitely going about a big cost-cutting effort right now. So they're going to be cutting jobs. Our understanding is that everything's on the table. So they could be looking to get deeper in retail banking here. They could be looking to beef up some parts of their corporate investment bank. I think it's still early and there's still a lot of decisions to be made, but they're definitely looking at the entire bank.
Jenny, thanks very much. Jenny Serrain, who leads our UK and Middle East finance coverage. Tom, let's return to one of the themes that we've been dealing with a lot this morning, and that's what's going on bond markets. And we've seen, of course, through the month of November, we saw yields coming down globally. The European expression of that, though, catching our eye today with those comments from Isabel Schnabel.
Yeah, interesting that euro-dollar, by the way, is not reacting as much as the bond. So that's absolutely right. We should focus on what's happening in the debt markets. And you're seeing that even reflected in gilts here in the UK. So gilt yields coming down by about 6 basis points on the 2-year. Similar picture on the UK 10-year. But Germany, of course, is in focus for us, as is Italian debt, BTPs. You're seeing Italian 10 years currently just above the 4% level, 4.05. Yields down 7 basis points. And just to remind viewers, this is in the back of comments from Isabel Schnabel of the ECB saying that there has been, quote, remarkable progress on inflation and that further rate hikes from the ECB are unlikely. So, as you say, Anna, this is a market repricing that scenario from the European Central Bank.
Okay, coming up on The Pulse, Francine Lacroix will be speaking to the Apollo co-president, Scott Kleiman. That's at the COP28 summit that is taking place, of course, in Dubai. They'll be talking about the impact of a rise in private credit on our ability to deliver on climate goals, that link between private credit, its role in the climate fight, an interesting one to explore. That is it for the Markets Today programme.
You can get more, of course, on the front page of the Bloomberg UK website or by typing TLIV Go. On the terminal, European markets, the benchmark down 0.1%. US futures down 0.3. This is Bloomberg.
we had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Dubai with the special coverage this hour from the 28th UN Climate Change Conference. We are day 5. Now, in just a moment, we'll be joined by Hubert Keller, Senior Managing Partner at Lombard Odier, and later this hour, we'll also talk to the Apollo co-president, Scott Kleinman. Now, there has been a lot going on here at COP. Today, we're also at the Green Summit, which is about an hour away from COP28, but it's really the focus today on the energy industry. Now, talks likely to get complicated for the final communique after Saudi Arabia said it will not agree to a phase down of fossil fuel use. Now, the phase down or phase out of dirty energy is a key demand of many countries, including the US and the EU, but any agreement must actually be supported unanimously. Now, COP28 has had some early successes, though. More than 120 countries have committed to triple global renewables capacity by the end of the decade. Rich states have also promised hundreds of millions of dollars to compensate poor nations for the effects of climate change. So to put all of this into context and look at climate financing, joining us now, Hubert Keller, who leads Lombard Odier's also efforts on sustainable investments. Hubert, thank you so much for joining us. Now, what you're trying to do at the firm is extremely interesting because you're putting climate into almost every model because you believe there's going to be a big shift. Talk me through it.
That's exactly right. So you see, we are an investment firm. We are an active investment firm. And for some years now, we decided to put effectively sustainability and more specifically the environmental transition at the heart of our investment conviction. So that's why we're very focused on it.
So first of all, how do you measure that risk? So this is all about risk, right? You talk in financial terms.
It's about risk, but frankly, it's even more about returns. The way we see it is that we are at the beginning of the most profound economic transformation of all time. I think what is underestimated by the markets is the speed and scale at which this transition is unfolding, and it's the level of disruption that it is creating in the real economy. So, as an investment firm, we want to be focused on the business models of the future, and we indeed want to try to move more and more rapidly away from the business models of the past.
But it's quite actually rare to have someone say that this will be accelerated. So are you expecting in the next couple of years to be at escape velocity, meaning once you get enough funds, the transition kind of, goes off?
So I think we have to make a distinction between what's happening in financial markets and what's happening in the real economy. In the real economy, things are happening at speed and scale. You have to remember that when you think about the environmental transition, 90% of the solutions already exist. Some of them have passed breakthrough points and are moving at speed and scale. If you think about the building block of electrification or electrification generally, we are in the process of electrifying the supply side and the demand side of our energy system. It is happening at a speed and a scale which is vastly underestimated.
So where do you think the smart money is going? If you look at some of the projects or where you want to be invested in?
So you see, we are a multi-asset organization. You know, we look after about $300 billion of assets for our clients. And, you know, we need to be able to deploy capital across all asset classes. And so we need to find opportunities on the transition, on the environmental transition, across multiple asset classes. So yes, there are some really interesting solutions in private markets, but there are also some really interesting opportunities in public markets. And remember, you know, the transition isn't just going to be about the tiny little new solutions. The transition is going to be about the big incumbents shifting, and it's also going to be about the new Tesla of this world.
And this is across the globe, or are there regions? Again, we have the Inflation Reduction Act. That, of course, helps with innovation. It brings, you know, the price of renewables down. So do you favor the U.S. over other regions?
So I think I think in developed economies, the electrification of the economy is really moving fast. I think there are questions still around emerging markets and developing economies, undoubtedly. I think the big topic for developing economies is the nature agenda. And I think we as an investment firm, we would, for example, think that nature is going to become a really big asset class. We actually potentially think it's going to be like global real estate. So it's going to be really interesting. But I think, you know, there are indeed slightly different perspectives whether you are, you know, living the economic reality in developed economies or in emerging economies.
What have you found most interesting at COP28? Is there a pool of private capital that just wants to be used waiting for the right project?
I think when we're talking about financing the transition, we really always need to, you know, come back to something really important. The green economy, or building a green economy, is basically about building a better economic system. When this becomes clear, capital is flowing and flowing rapidly. And the capital is coming from corporates. We, as financial investors, we are going to invest in corporates that are making the right investment for the future and are going to be able to drive growth and profit from that new green economy. And I think that's always very important to bear in mind. So we think, for example, just in electrification, we are on course this decade alone to spend annually between 3 and 3.5 trillion in electrifying our economy. So these start to be really big numbers, and we're seeing happening in reality.
So, and what you're saying about is that this will happen no matter what. So, you know, we worry politically, we worry about not enough regulation, not enough compulsory things.
So I think this is a really good question. There are parts of the transition that continue to need policy support and intervention, but frankly, there are parts of the transition that now are moving firmly towards mass adoption. And frankly, they are because, again, these are just better technologies and they're going to build better economic systems. I think it's quite important that we realize that. What is underestimated by the market is the level of disruption that it is creating in the very structure of our GDP. We've seen it, for example, with electrical vehicles. You know, when better economic systems emerge, effectively you have entire systems that are changing, you have value chains that are getting reconfigured very, very quickly, and you have profit pools shifting from one place to another, margins, you know, moving left, right, and center. So it is an important, from an investment perspective, it's really important to understand all of that.
So does it matter? We're focusing a lot on, you know, the energy transition, and the fact that maybe the phasing out or phasing, you know, off of fossil fuel will not end up in the final communique. Does that matter to you as an investor?
As an investment firm, not really. I'll tell you what really matters from an investment perspective around big oil companies is the fact that they are basically not willing to engage with their shareholders on the future of their business model. We believe we're going to move towards electrical vehicles 60 to 70%, even more, 80% between now and 2030. This is huge. The world of electrical vehicles takes 45 million barrels of oil every year from the demand. That's nearly 50%. So why can't we have a conversation as shareholders, as investors, with this big oil business saying, what is the future of your business?
Are there any other points of innovation that you're very focused on? I don't know whether it's carbon capture, whether it's you know, some of the new things, nuclear fusion. I mean, would you invest in nuclear fusion now, or it could be 20 or 30 years away?
Look, our view is relatively simple. We're moving towards a world that is going to be electrified. And the cheapest source of electricity today on the planet is solar, wind, and batteries. This is the cheapest by far, and costs are continuing to go down. And that's really good news, by the way. So yes, there will be other technology possibly emerging, but you know, at scale, to this, you know, to the extent that we're seeing with solar, wind, and batteries, I think we're going to need to wait much longer.
When you talk about energy companies and fossil fuel, you know, having that discussion with shareholders, do you think at some point there will be almost a mandatory disclosure for all companies to look at the risk of climate change longer term?
I don't know, but you know what? As an investor, at some point, I'm going to ask, why should I discount to anything but zero the capex going into a new fossil fuel project? And then you open the question of, okay, so how do you value the rest of the business?
And do you think more asset managers will look at doing that?
I think this is a little bit of a normal question to ask. I mean, big oils, in a world where the demand of oil is shrinking and shrinking rapidly, they have a business model issue, which, for some reason which I do not quite understand, they are not willing to address.
Hubert, thank you so much for joining us. Hubert Keller there of Lombard Odier Group. Now, we'll have plenty more, of course, throughout the day here at COP28. There's a blue zone. I'm actually at the Green Summit of Bloomberg. We'll also bring you our interview with the chief executive of Total Energy, Patrick Pouyanné. He says high oil prices are actually good for climate change. So we'll have plenty more on that interview next. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The conversations that matter, the insights you need. This is a pulse, and I'm Francine Lacqua here in Dubai from COP28. Now, Saudi Arabia's energy minister says the kingdom will not agree to any COP28 text that calls for the phase down of fossil fuels. In an exclusive interview, Abdulaziz bin Salman told our very own Will Kennedy that if countries believe they can reduce hydrocarbon use, they should just get on with it.
I'm not naming names, but it's their choice. If they see that we should phase out and phase down hydrocarbon or hydrocarbon, I don't care about fossil fuel, I care about hydrocarbon. If they do, please, I did once in the FII, just the last FII, I said, please, those countries who really believe on phasing out and phasing down hydrocarbons, you should come out and put together a plan for how, starting 1st of January 2024, when are they going to freeze? Well, they should at least freeze their production by January 24, and also put together a plan for when that descendance or phasing out will happen.
You mentioned this phase out, 500 miles from here in Dubai. Many thousands of people are doing the annual climate summit. And one of the issues there is this language, which we discussed actually last year, about whether that text agreed to by almost every country in the world should say fossil fuels should be phased down. Are you happy to have that language in the text this time?
Absolutely not. And I assure you, not a single person in that, well, I'm talking about government, do believe in that.
Okay.
But if they believe in it, I would like to put that challenge for all of those who believe, who comes out publicly by saying we have to do that. Please give me their name and numbers and look at it. Well, I'll give you their name and number, call them and ask them how they are going to execute that effective January 24. If they believe that this is the highest moral ground issue, fantastic. Let them do that themselves, and we will see how much they can deliver, if they can deliver.
Well, that was the Saudi Energy Minister Abdulaziz bin Salman saying the kingdom will not agree to a text that calls for the phase down of fossil fuels at the COP28 summit here in Dubai. Now, it is one of the key demands of many parties at COP, including the US and the EU. Now, he also told us that oil production cuts by the OPEC Plus alliance can absolutely continue past the first quarter if needed in order to stabilize prices. That was the Saudi oil minister. Now, we also spoke to the chief executive of the French oil major, Total Energy, saying high oil prices are good for the climate. That's what he told our Youssef Kamaldin on the sidelines of COP28 in Dubai. Here's Patrick Pouyanné, who also argued that carbon offsets are part of the solution to fight climate change.
I think, honestly, what has been done, putting together more than 50 companies around the platform with clear commitments of Scope 1 and 2, which means the emissions of the oil and gas industry. You know, the emissions of the oil and gas industry represent 10% of the emissions today, 5 billion tons. So it's at stake. And I think putting that together, and in particular, the big step forward has been to engage national oil companies from many countries, which was today a little behind, you know. They are now on the same platforms.
Let me build that out a little bit, just in terms of CCUS, because a lot of people are saying that this is a way for big oil to avoid fighting climate change. What do you say to those who are saying they're mounting doubts about carbon offset?
No, I think it's part of the solution. You know, by the way, when you speak about CCUS, there are different things there. You capture, U is use, transforming CO2 as a material, which I think is probably one of the future. S is storage. It's not the solution, it's part of the solution. But you know, when you are a cement industry, it's not for oil and gas, the cement industry, what do? You need to do cements, you need carbon. What do you do with the emission? You need to capture them and to do something with CO2. So I think it's part of the solution, not the solution. It's not the oil and gas industry, which is reintroducing bad technology. It's because of the hard-to-abate industries, cement, aluminium. But again, it's one solution.
Are you seeing a softening in demand?
I'm not sure. No, I think this year there was an increase in 23 of +2. Next year is +1. So it's still growing. Why is the demand is growing? Because the population is growing. So it's not +2 was quite a big step, because in the +2 of this year, you had part of it was a recovery of China compared to the year before. In fact, the oil demand, when you look is growing by 1% per year, so it's +1, +1. So then, of course, you have the global economy, macroeconomy, which could add there. So the softening of demand is not the same hike, but it's still a hike in 2024. So we need to continue to supply.
I mean, the thing is, because of that growing supply, Citi, for example, in a new note suggests that the prices could go down to $70 a barrel by end 2024. You think that's a bit of too pessimistic a scenario?
Well, I'm not sure. I'm price taker. My company, I have a break-even with post-dividend under $50, so 70, 80. No, I think it's there is today supply and demand. There is a volatility in this market for sure. But it's good to have also some supply. And for consumers, it's also good not to have a price which is too high. Yeah. Clearly, in France, when the rich gasoline price at €2 per liter, people or consumers are very unhappy, and we put a ceiling on the price to try to tackle these high prices. So I think even for the oil market, when you have high prices, it's not too good. Having said that, it's good for the climate, because when you have high prices, you force people to save. Yeah. And it's good for all this COP28 and this discussion. Again, it's a matter of doubling efficiency, all that. So the price has really an impact on the behavior of consumers.
Well, that was our exclusive interview with Patrick Pouyanné, the chief executive of the French oil major Total Energy. Now, coming up, we'll have plenty more from COP28. The Bridgewater Associates founder, Ray Dalio, says the world is unlikely to achieve the climate pledges set out in the Paris Agreement. We'll bring you his take next, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX. So, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Let's be realistic. We are unlikely to achieve the 1.5 target. So there are three things.
what you can do to achieve the 1.5 target. The second is adaptation. Okay, if you don't achieve the 1.5 target, what needs to be done to make that acceptable? Of course, the consequences of not doing that are big. Big migration, all sorts of problems. But how do you adapt? And then the third cost is the cost of the damage. I believe that we're going to be moving in an economic way to adaptation, and that there's a lot of, that'll have a great power. And the reason is it affects everybody. So whereas there's an element here of let's be good and get the money. But if you go to, let's say, banks, they say banks have a lot of money, but banks have assets and liabilities. And if they don't receive or give their depositors or those who are putting money with them an adequate amount of return, they won't have any money.
Right.
So you still have to have the return component of that. What happens is self-interest is a great motivator when you have that. And I think adaptation will be some area for probably great investment and great productivity.
But Ray, isn't climate change the biggest risk really to any company? And so when does it actually, when do we see regulation that forces every company to look at it as the longest, biggest risk out there?
Well, I think Secretary Kerry did such a wonderful job of describing the realities of that. I mean, I think that's the balance. And so as a very practical person, one can't say it's going to be all or none. One has to look at actually what is it, what is happening. And I think as you're dealing with the regulation, that's right, that's good. And then there's also a meme developing that you're not a good citizen. Okay, that political aspect also plays, social aspect, meme, plays a role. Are you doing it well? Is a social pressure that has a role. So there's regulation, there's social pressure. Those are all good things that are helping. The real question is that enough? I mean, it's not like you have them or you don't have them.
Well, that was Ray Dalio, the founder of Bridgewater Associates, really talking about the transition, saying that even if we're unlikely to achieve the 1.5-degree climate target, as outlined in the Paris Agreement, he basically says that we are on the way there, so that the trend is still towards decarbonization, even if it hits bumps along the road. Now, here are some of the other top stories from today. Of course, we look at everything that's happening in markets. One of the other things, which is a very interesting conversation here at COP28, which is climate change and the funding of climate change, is we saw Altera. Now, this is a huge fund. Brookfield, we were speaking about it with Mark Carney. Brookfield, together with the UAE, actually trying to find projects with on both sides, a lot of money being poured in. I think it's around 30 billion plus. Now, coming up, Kleinman, the co-president of Apollo Asset Management, joins me here. We're live from Dubai at COP28. This is Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball, and the reason why Warren and I got to know each other is he insured my contract, the 252, I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
You have a large following on X, or what used to be called Twitter.
Sure.
Is that a plus for your business or a minus for your business?
At worst, it's neutral, but probably no one's going to want to have a proxy contest with someone with 900,000 Twitter followers.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua in Dubai for COP28. We're at day 4. A lot of investors tired, but actually they keep on going because they know there's money to be made in certain parts of the markets with the green financing. Now, we're just getting some breaking news from the London Stock Exchange. We had a communication from them that they're investigating an issue impacting trading. Now, this we understand through just their press release moments ago saying they're investigating an issue with its trading and information system. So we'll, of course, keep a very close eye on it. They say they're undertaking some immediate analysis and will give further updates through its live service portal. So if you're a trader at the moment, hold on tight. We're told by the London Stock Exchange that they will, of course, update you with anything that's happening, and you can always tune into Bloomberg because it will bring you all of the latest updates as well. Now, back to COP28, and the IMF has called for more ambitious policies and innovation globally in order to meet climate goals. It says that in order for nations to achieve net zero by 2050, private investment is crucial, especially in emerging markets. So what role does private credit play in progress towards meeting the goals in the Paris Agreement? Well, one man knows the answer. He is Scott Kleinman. He's co-president of Apollo Global Management. Scott, great to have you here.
Thanks, Francine. Good to be here.
So this is the money question. What role do you see credit doing in all of this?
Well, it's massive, actually, right? If you just take a step back and think about the amount of capital required to achieve decarbonization, right? The world's talking about decarbonizing by 2050. That's going to take somewhere between $200 and $300 trillion to achieve. That's more than $1,000 a year for every man, woman, and child on the planet. Governments don't have that much money. Companies don't have that much money. And so that's going to have to be supplemented by private capital. Private capital in venture form, but also in equity, in credit, in infrastructure. It's just a massive need for capital.
But Scott, so first of all, is that capital available? Is it going to be taken from somewhere, or will that capital be available when we have more viable projects?
Yeah, look, I think it's growing as we speak, right? Thus far, when people think about climate investing, they often think in terms of venture or really new technology. But the reality is the bulk of the $200 to $300 trillion that needs to be spent is in regular way energy transition. Industrial companies, auto companies, manufacturing, energy companies need to put the capital in. It's a very capital-intensive process to convert from old energy, to new energy, new infrastructure. And that just takes enormous capital. That capital will be there as projects start to arise.
But so what kind of projects are you looking at? And is that like with some of the big development banks, is it the World Bank to kind of have an anchor, or are you going at it alone?
No, it really comes company by company, as it could be anywhere from a recent transaction we did with Air France, where we provided $1.5 billion private credit financing for them, a portion of which was used for sustainable aviation fuel, as one example. Another example, we financed a renewable energy developer with a $600 million project finance loan. So really runs the gamut of projects.
But I think you appointed a chief sustainability officer like 2 years ago.
That's correct.
Again, is that for like a big transition? Is climate and ESG and the change, I guess, in the economy going to filter through all of your investments, or is it going to be quite slow?
So think of sustainability as part offense and part defense. Defense is about getting your own house in order, taking the companies you own and just driving sustainability into them, whether that's part of the investment thesis or not. And that's what our chief sustainability officer focuses on.
Because of risk? So is this from just
because
a risk
of risk
perspective?
and because of opportunity. But then there's also offense, right, which is how do you invest in climate-oriented investments, sustainable investments, where you can create value going forward and have just very interesting, viable investment opportunities.
Again, from an investor point of view, do you think some of these opportunities will be slower or quicker than we think? There seems to be, we're at the start of money, but I guess at some point you could have escape velocity. So 30 billion, for example, in Altera could turn into, a template for other projects.
I think you're going to see this grow exponentially from here. Really, every year you're seeing more and more capital flow. Thus far, like I said, it's been concentrated in a lot of venture and technology investments. I think you're going to see the scale of capital grow massively into infrastructure, private equity, private credit, financing a lot of different aspects of sustainability.
Scott, what are you most interested in? So is it emerging markets? Is it, the U.S., there's a ton of money because of onshoring, because of the Inflation Reduction Act. Like, what are some of the key regions that you think this will accelerate?
Apollo's primary focus area is North America, Europe, and developed Asia, and that is really the areas that we focus on, and I would suspect the bulk of our sustainable investments will come in that area.
When it comes to climate tech, is there one big bet that you want to, or is it?
No, I would say there's no one big bet. Really, we need all of the above to happen. Everything from decarbonization in companies, carbon air capture activities, to hydrogen seems promising, but still years away from private investment in any meaningful way.
Give me a sense again, in terms of credit offsetting, this is something that Apollo wants to be a bigger player on. Like, how much bigger do you think that space will be? And would you give it to fossil fuel companies? Like, how do you see that?
Absolutely, right? Again, this is all about transitioning. It's called energy transition for a reason, right? Traditional companies have to, little by little, evolve their manufacturing footprints, evolve their operations, evolve their products to be more sustainable. And that just takes capital. And so all of these companies are target opportunities.
How often do you think about the Fed? So markets obsessed with inflation, obsessed with the Fed. They think we're definitely getting cuts next year. Are they wrong?
I would personally bet against it. I think it's going to, the Fed has been very clear about staying higher than we think and staying longer than we think. And I think that's the right way to think about it. I think the market's a little too optimistic.
Okay, what does that mean for finding deals? I know Apollo has been extremely active in many spaces. Is it an opportunity as you see the economy maybe wobble a little bit in certain countries with question marks over debt?
No, I think actually higher rates ultimately are better for the deal environment, right? Higher rates mean more sensible valuations, less leverage on companies, and that actually jives very well with the Apollo investment strategy.
Are you seeing more sensible valuations? Because we hear there's still like a 15-20% gap between what owners want and what buyers are prepared to pay for it.
No, we are. It's been an incredibly busy year for Apollo. We've executed in our private equity business on about 9 or 10 transactions, over $6 billion of capital deployed. There are lots of companies that are just trading at more sensible valuations and are willing to transact at these valuations.
We're December 5th, so I feel I can ask you about 2024. Like, what are you most excited about next year? Like, where are the biggest opportunities?
I think 24 is going to be a volatile year. A lot of unexpected things geopolitically, economically, And volatility tends to be good for Apollo. We like the uncertainty. We like the opportunity that volatility creates. And so we think it's going to be actually a pretty good year for deployment.
Where do you see the most volatility? I know commercial real estate is the one where you have red alarms going off for 2024.
Yeah, look, I've talked about this before. I do think the real estate market in general is due for a pretty sizable correction. I think that's going to play out over several years, not necessarily on a date in 2024. But we're going to be prepared to play a part in that.
So meaning that when refinancing comes and people will sell the distressed assets, you could be a buyer in some of those
or just providing capital to companies that need to refinance. Sometimes it's a restructuring. Other times it's just support capital, deleveraging capital for companies, for real estate, for otherwise.
Scott, what do you think the market is getting wrong right now?
I think the market is too optimistic on the outlook for 2024 fundamentals, as well as the interest rate cut environment, which I think the market is just way too exuberant about.
Scott, thank you for joining us. Scott Kleinman there, the co-president of Apollo Global Management. Now, we'll have plenty more, of course, throughout the day here from the Green Summit at COP28. Also, we have an update from the London Stock Exchange saying only FTSE 100, FTSE 250 and international order books are now available for trading. So I know this is something that if you're at your desk trying to make a trade is something that you'll watch very closely. Again, they said moments ago they were having issues with the trading information system. We'll have plenty more from COP28 coming up. We speak with Mark Carney, the chair of Brookfield Asset Management and UN Special Envoy on climate action and finance. He's also playing the part at Bloomberg. He's coming up next, and this is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The conversations that matter, the insights you need. This is a pulse, and I'm Francine Lacroix in Dubai for COP28. Now, Mark Carney, chair of Brookfield Asset Management and UN Special Envoy on climate action and finance, spoke to me about the UAE's plan to put $30 billion into a new climate finance fund.
First is to respect what the UAE is doing. $30 billion dedicated to transition finance. It's a huge amount of money, but especially important, as you say, for a new template. They put out a new template for finance in the emerging and developing world. So a substantial portion of that $30 billion is catalytic finance. It comes in at a different return threshold. It's focused on the emerging developing world across everything from technology to clean power, sustainable living, and we're thrilled to be a part of that. Combined, we have a partnership with Altera, the new vehicle, where they're putting in $3 billion across our transition strategies. We expect to have over $20 billion raised and focused across the emerging developing world and transition more broadly.
So where's the smart money going in terms of that transition fund? Like, what are the hot projects right now?
Well, I think, look, it's a wide range. So one of the focuses of this COP, as you know, is to triple renewable capacity. So think solar and wind and battery storage, conventional, if you will, renewable technology. That's been growing exponentially around the world. It needs to keep going. We see enormous opportunities in those regards. Just again, to bring it back to Brookfield for a moment, our deployment rate is about 7 gigawatts a year. So we're growing at 7 gigawatts. We already have over 30 gigawatts in operation. We have 140 gigawatts in our backlog. We're pushing that out. With respect to the emerging world, that new fund, we call it our Catalytic Transition Fund, so it's an emerging market, developing world focus. We've identified 6 gigawatts of projects already. 1.2 gigawatts will be deployed there. But that's just one of the opportunities. The other big opportunities, you say, where's the smart money going? The smart money now is rushing towards where the emissions are. So we're thinking heavy emission sectors, if I may. So that's transportation, that's chemicals, that's steel, and it's getting those emissions down because you can come in at a low valuation, you're solving a big problem, and you're having both a high financial return, but for the planet, you're having a high emissions return as well because you're getting a lot of carbon out of the atmosphere.
But is there a danger that so we also have this loss and damage fund, which is basically transferring money to emerging markets. But I was looking at numbers of onshoring in the U.S. I mean, we're talking like millions of money going into the U.S., partly because of onshoring, partly because of the Inflation Reduction Act. So how does that change things?
Yeah, well, so loss and damage is dealing with a separate issue, if I can say. It's related to climate change, but it's the impact of what's happened historically. So it's an issue of global climate justice. It's not really an investment set of issues. But as you say, there are many things happening, and with the IRA, it is attracting a lot of capital into the United States. Look, the U.S. has to get emissions down as well, and the world will benefit from what's happening in the U.S. because it's driving down the cost curve for new technologies, hydrogen, carbon capture, and storage. I mean, these are existing technologies, but they haven't been commercial at large scale. The IRA benefit and the amount of capital, and we're very involved in this, amount of capital that's being deployed is going to lower the cost of those, just like the UK did for wind technology. The whole world benefits from that, as they will with the IRA.
Well, that was Mark Carney, chair of Brookfield Asset Management and UN Special Envoy on Climate Action and Finance. He's also the chair of Bloomberg. Now, here are some of the other stories that we're keeping an eye on, of course, today. We start with Israel. Israel's military is expanding its operations further into the southern Gaza Strip, with reports of strikes hitting Khan Yunis, the territory's second largest city. Now, the stepped-up fighting comes after increased warnings from the U.S. to limit civilian deaths. The Hamas Foreign Health Ministry reports over 15,000 people have been killed since Hamas attacked Israel. The Kremlin is reported to have confirmed that Russian President Vladimir Putin will make a rare trip abroad to the UAE and Saudi Arabia tomorrow. According to one Russian report, Putin is expected to meet with Saudi Crown Prince Mohammed bin Salman. And Hungarian Prime Minister Viktor Orban has again warned that the EU against discussing the start of membership talks with Ukraine at a Brussels Leaders Summit next week. Now, Orban made the demands in a letter to the European Council President, seen by Bloomberg. Unanimous support from all 27 member states would be required for Kyiv succession. Coming up, the U.S. Special Envoy for Climate, John Kerry, warns of the monumental dangers of climate change at COP28. More on what he had to say next, and this is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
The dangers that we are facing, folks, and I am not an alarmist. I think most people know I've been pretty practical in trying to find solutions to challenges. But the dangers we face now are just monumental and even scary. And scientists are saying that. The best scientists in the world are saying what we face now is alarming, terrifying. These are quotes. And even we are in uncharted territory. Now, let me just say to you, it was 70 degrees Fahrenheit above normal in the Arctic last summer. It was 100 degrees Fahrenheit above normal in the Antarctic. And a massive ice sheet that has been tied up for whatever thousands of years, because it was so big and heavy, it was stuck in the mud, has now disappeared enough, melted enough that it floated, it's no longer stuck. It's moving out towards Georgia Island. It's going to melt. Just like 86 million metric tons of ice every single day in the Greenland. So we got to really decide, are we serious or are we fooling around with an existential issue? Existential. You hear that out of the mouths of sober politicians who are not playing politics, who really understand what's going on. So I do that as a preface because it has to be the guideline, the guidepost for everything we're thinking about and choosing to do. And the fact is, emissions are going up in too many places. And what the science says is, IPCC 2018, they could not have been more clear. They pointed the finger at all the people in positions of responsibility. You have 12 years within which to make the decisions and implement them, obviously, that will avoid the worst consequences of the climate crisis. That's science, mathematics, physics. And we're ignoring it in too many parts of the world. And so we're inviting the worst consequences. And we see what's happening. 18 $1 billion events in the U.S. climate events last year, 18 $1 billion separate events. Meanwhile, 30 million people displaced in Pakistan, record fires in Greece and parts of the world. Come on. When do we get sort of, really focused on this?
Well, that was the U.S. Special Envoy for Climate Change, for Climate, John Kerry, speaking at COP28 with our very own John Frouwer. Well, let's get more on what Kerry said in that discussion with our head of Green ESG and Equality, John Frouwer. John, it was a fantastic conversation. Also, he was fired up, and he was also quite funny. I mean, the room really couldn't get enough of it.
I mean, he left with a mic drop moment. He was in great form. You can see how he was very nearly president of the United States. He had this clear magnetism on stage, but he also had, he was in robust form about the need for action at this COP. He was defiant in the face of criticism about U.S. policy. He had a lot to say.
Yeah, so he kind of went after Trump. We were expecting that, but he also kind of went after Chevron.
That's right. So one of the big stories of this COP has been how fossil fuel companies are coming into the mix. And of course, the US was a big part of this methane announcement of the weekend, where 50 big oil companies signed up to it. However, Chevron, they're not contributing money to this methane fund that's been set up. And Kerry he didn't really hold back in terms of how Chevron in particular needs to do more. It's quite rare for such a senior US official to specifically call out an individual company. So it'll be interesting. We have calls in to Chevron to see what their reaction is, and it'll be interesting to see what they have to say to that.
I mean, the big debate is whether, the phasing out of fossil fuel will end up in the final communique. Does it really make a difference for the climate agenda?
So there's two schools of thought of this. On this, I mean, words matter. The Paris Agreement was just words on paper, but it did have a huge, impact over time in terms of sending a signal to the market that, the energy transition is real. There is another school of thought. I think we had someone from KKR on one of our panels yesterday making the point, communiques don't spur investments, right? Investments are, if I think I'm going to make money from this, I'll invest money. So there is this sort of debate over this, but certainly for the next 10 days here, this is the only thing that people are going to be thinking about. Climate diplomats like Kerry do believe passionately in these communiques. And the big question is, will this communique, will they agree, will they get everyone around the world, all these countries, to agree to a phase out of fossil fuels, which, if it happens, would still be a big moment in climate diplomacy.
Yeah, but you're right, it has to be unanimous. It's so tough to find that. And then, I mean, in the last hour, we had this pretty incredible news, actually. Interfax, which is a Russian news agency, saying that the Kremlin has said that Putin will visit the UAE and Saudi Arabia tomorrow.
So we're still reporting that out to see, is he actually going to come to COP? That would be a rather incredible moment. It would certainly further complicate the whole fossil fuel question if he were to come here. But this is literally breaking news, so we'll have to find out more. But it is interesting. He hasn't left Russia that much since the war started. Again, it's just an example of how he's feeling increasingly emboldened as the war in Ukraine goes to a stalemate.
We'll be watching that very, very closely. I know our team are, of course, making calls as we speak. That was John Farrar, head of Green, ESG and Equality for Bloomberg. Coming up next, we'll have plenty more from COP28. So we're just getting started. It's like we're day 5 of COP, or day 4, and we have another 8 days to go. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. we earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
China under pressure. Chinese stocks close out the day at a one-year low as Moody's cuts the credit outlook to negative. The BOJ remains the only major central bank left with rate hiking expectations, while the RBA holds and the ECB Schnabel says further hikes are unlikely. The Saudi Minister for OPEC says supply cuts can stay absolutely past March for next year.
I honestly believe that the delivery of the 2.2 will happen. 2.22 million will overcome even the usual inventory build that usually happen in the first quarter.
All this as the Russian President Vladimir Putin plans to visit the UAE and Saudi Arabia on Wednesday. Let's see, does he visit COPs? So you've had a reality check. Moody's has delivered a real reality check to China. They flipped the outlook to negative from stable. Yes, they have affirmed the A1 rating. But look, this is the Hang Seng, the trajectory of this market. We're down 50% from its 2021 peak. Asia, MSCI Asia today finished at the lowest level since late 2022. And all of this is predicated on a lower medium-term growth outlook, bigger financial support for the state-owned enterprises. I just wonder to what extent is this a confirmation bias of what the market has already done? They've been heavy selling. $1 billion worth of stock was sold today. What is the ripple effect? We'll wait and see. As I say, in some ways, this is a confirmation bias. To the S&P 500, you've had a 5-week ascendant rally. We're up 20% so far this year. So you are just seeing this pause, this momentary pause for thought. Is it over-exuberance, overtired, overbought? 1 year ago, the market was presuming just a 20% chance of a rate cut in March 2024. That probability is now 70% for March and 125 basis points for the whole of next year. Asian stocks are still trading. As I say, China has closed, but Asia is just taking a tilt to the downside. Keep an eye on the Russell 2000. You have this small flip from the S&P into the broader market. Keep an eye on that. But of course, JP Morgan say, look, stocks are imperiled by this Goldilocks setup that we have. To London, down 1/3%. We've had some outages in London, and that's something which the LSE are reopening and rehabilitating at the moment. They are resuming trading in a number of impacted instruments. But keep an eye on Barclays, because the QIA was a monster investor in Barclays, and the fund, the QIA, is selling almost half of its Barclays stock. They were the top investor with a 5% holding. Be wary. They've been there for a long time. What does it say about the new strategy? Danny, good morning.
Good morning, Manus. You have these individual stories, but as a whole, the market has seemed to lost its mojo over the past 24 hours. Bonds sold off yesterday. Maybe it was exhaustion. Maybe it was the corporate deluge. We're back up about 4.2% on your 10-year yield, though we are dropping slightly 1 basis point. So a rally today. Maybe that has more to do with the rest of the world than it does the U.S. In Germany, your 2-year yield is trading at its lowest level since May after Isabel Schnabel of the ECB gave an interview to Reuters. Well, she said it is unlikely that we will hike again. She is the arch hawk at the ECB, so when she speaks, the market listens. You also have a dovish story coming from Australia. The RBA held, but it was interpreted as dovish as well. They talked about economic risks. They talked about being more cautious. Therefore, you get this drop, this weakening in the Aussie dollar, down by about 0.7%. Those are your markets, Manus, but taken all together, I want to show you what it means for the globe. We are now in a period of not synchronized tightening of this past year, but synchronized cutting. That is at least what this market is betting, despite everyone talking about higher for longer, hawkish holding. For a radio listening audience, I basically have a bar chart of the top central banks of developed markets and what they're going to do. It's a cut from the Fed, it's a cut from the ECB, a cut from the BOE, a cut now with today from the RBA, according to markets. Manus, the last hawk, if we can call it a hawk, standing is the BOJ. Markets think that they will hike 20 basis points come 2024. And that's what Peter Kinsella said to us the other day. He went into 2023 with yen as being his top bullish trade. He still holds that view. 140, 135 is eminently possible. But of course, the bigger, perhaps, trade is the euro-yen trade. If you're going to see that flick to 20 basis points of a hike by the BOJ, rip off the band-aid, which is YCC, just what momentum does that give to the yen? And can that perhaps push the euro a little bit more aggressively? We'll ask our FX guest that very question in just a moment. Danny, let's talk about the Moody's move, cutting the outlook for Chinese sovereign bonds to negative, citing growing risks, persistently lower mid-term economic growth, and an overhang from the crisis in the property sector. Joining us now is Sofia Horta-Acosta. So, Sofia, one could say that Moody's are slightly late to the party. A number of their cohorts have already taken the scythe to China, but this is about debt, and that is the peril of the world at the moment. So what are they saying about the debt levels and the responsibility in the China context? Good morning.
Good morning, Manus. So essentially, what's interesting here is that everything that economists have said for months and months and months that Beijing needs to do to boost growth, to boost the economy, is actually what's leading Moody's to cut its outlook on China. This is fiscal stimulus. And of course, for any government to afford a ramp up in fiscal stimulus, it needs to sell more debt. It needs to worsen its debt burden because interest rate cuts and injecting more liquidity into the financial system, monetary stimulus, that wasn't moving the needle at all. So Moody's is saying actually this makes the debt profile of China more risky. This is not a debt downgrade though. This could take months. It could even not happen because if the outlook changes in the next few months and Moody's just changes the outlook to stable, we might not get that downgrade at all. But it really shows perhaps the market was already expecting this because the market was already so downbeat on China.
Yeah, I mean, it's fair. Only really stocks are reacting to this, so you don't see much of a reaction in currency. I mean, it was already down before this anyway. And you mentioned China has had effort after effort. We can argue how big or how small they were, but they have done a lot to try to reinvigorate this economy. What is left for Beijing to try to do?
I think fiscal stimulus is really the one thing that makes sense. What markets really want, though, is evidence that the economy doesn't need stimulus anymore, so actual real growth. And this is why, Danny, we saw those PMI figures today. I mean, PMI, that's been a really complicated picture. Every time I come here on your show, there's either...
I ask you what the heck's going on with it.
There's either a better than expected or worse than expected figure. Today was a little bit better than expected on services, so not as important as manufacturing. But again, the economic picture for China is not clear. And it's the only thing that's clear is that more stimulus is needed. The market wants to see an economy that can grow on its own 2 feet without that kind of help. And it looks like 2024 is not going to be the year that we get that, even though, there are expectations that the government will target a slightly more ambitious growth target than perhaps people had been expecting.
Yeah, I mean, they're clutching that 5% target, for dear life. Look, there's also a certain amount of pressure, one could say, on the geopolitical tensions. And this is interesting because you've got the U.S. Commerce Secretary, Gina Raimondo. She's defending plans to restrict the chips. We know that story for the world's second largest economy. This is what she said. China is not our friend. China's foreign ministry responded overnight saying the U.S. was, quote, should stop seeing China as a hypothetical enemy and saying one thing but doing another. I mean, this is after the sort of the huge fanfare on the West Coast of Xi Jinping being here. We know the Biden gaffe over his comments about Xi, but you know, is this a reality check again, not just from perhaps the rating agency, but from the administration in terms of how they really see China?
I think it is, and it's a reminder also that this geopolitical risk, this cloud that's kind of hovering over Chinese assets, at least from a global investor perspective, is not going away. I think there was some optimism around this Biden-Xi meeting, the first in more than a year, that, you know, there were friendlier ties, that Xi Jinping was kind of presenting China also in a friendlier way on the global stage. And this is very much a reminder, I think, Raimondo's quote there, that, you know, the U.S. and China are not friends. They're competitive, two competitive economies that will continue to compete. And it looks like, you know, the concerns over the tech sanctions and those restrictions from the U.S. are not going away either, Manus.
Right. Sophia, thank you so much for joining us this morning. That is Sophia Orta y Costa. All right, Manus, let's get some of the other top stories that are trending on the terminal this morning. Qatar's wealth fund offloads almost half of its stake in Barclays. It's a surprise move as the bank readies a strategic overhaul for the next year. Barclays shares are now down more than 2% in London.
Well, AT&T picks Ericsson to modernize its U.S. wireless network. The deal could be a value of $14 billion over the next 5 years. The project is a significant win over Nokia, which accounts for about a third of AT&T's business.
And more mounting China pullback. Eastspring Investments and Barings have been cutting jobs at their China hedge fund operations. That's according to a Bloomberg report. The slumping Chinese stock market has been weighing on the performance of many global funds run by global asset managers. Manus.
Coming up, we're going to dig into this FX narrative. Sonia Martin, head of FX and monetary policy over at DZ Bank, joins us next. Danny.
And we also have our exclusive interview with Saudi Energy Minister Prince bin Salman and why he believes the 2.2 million barrels of cuts will happen. This is Bloomberg.
Much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The
Connection
Pulse,
Law.
every weekday at 9 a.m. only on Bloomberg.
It's Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. So we had a very neutral RBA today, Manus. They held rates. The market decided it wasn't neutral. It was dovish. So now the BOJ, I mean, this is the world we're living in, Manus. The BOJ is now the lone hawk, if you can even call it that. It's the only central bank at the moment in the world that we are pricing in tighter policy. Let's bring in Sonia Martin, head of FX and monetary policy at DZ Bank. Sonia, if I look at that chart, the country that sticks out, not just Japan, it's also Europe. It's the ECB, Schnabel sounding oddly dovish. You had weak data coming in from Spain, from other countries today. Do you look at that and say, all right, I'm just going to short the euro all the way to parity and beyond?
No, definitely not. I actually think those rate cut expectations are vastly overdone. I mean, we have pivoted from, higher for longer, as you just mentioned on the show as well, to, cutting aggressively early, everyone at the same time in weeks. And, yes, I agree, inflation has come off, but, everyone's talking about the fact, or should be talking about the fact maybe, that the last mile is going to be really difficult here. The inflation is going to continue to be lower than it was, for the last year or two, but it's not going to go back to target for some time to come. So I don't think at all that central banks will be able to cut as early and as aggressively as the market is currently pricing in.
So if that's your starting point, then what does that do to the euro trade? I mean, the market is baying for cuts by May or April or May of next year. The same for the Fed. I mean, if you look at the euro in the first instance, if Japan pivots, surely the trade is short euro yen.
I would agree that the trade might be long yen. I'm not sure if the trade necessarily needs to be short euro yen. I think, when you look at the Eurozone, yes, the economy is weak, inflation has come off, and there is going to be a cause for cuts. But as I just said, it's not going to happen as early as the market is expecting. Now, in terms of the BOJ, I mean, we've talked about this quite a few times this year, and we have been quite bullish on the yen. And yes, admittedly, we haven't had the turning point yet, but that is a story that is going to happen next year. I mean, the BOJ has maneuvered itself with its back against a wall. They will need to abandon YCC. They'll have to find a way to do this, and that's going to be the turning point for the yen. But I actually think not necessarily that euro yen is the way to go, if you will. I think sterling, I quite like short sterling yen, to be honest. Strikes me as an interesting trade. But definitely long yen,
Why,
yes.
Sonia? Why short sterling?
Well, whenever we talk about the UK, it's not very positive, and I stick to that view. I think, we don't have very good fundamentals here. The inflation rate is still really high. The consumer is sort of being weighed down by all these sort of factors, high interest rates, high prices. We've seen, retail sales quite soft. I think the UK may not be heading into a disaster, but it's definitely not looking up either. So I think that might be an interesting, cross to watch next year.
So if the UK is wearing perhaps one of the dirtier shirts, might they have to cut earlier and faster perhaps than is presumed, and all the pushback in the world? I mean, if the Bank of England just stayed a little bit more quiet, it would help us all, because they flip and flop in their views. They really, really do, from table mounted to pushback, whatever. I don't know where we are.
Man, but the unreliable boyfriend.
I've had many.
Yeah.
So, within that context, Sonia, could the UK go earlier and faster than everybody else?
Well, for that to happen, inflation needs to come down quite a bit. And that's the big problem. I mean, yes, we might all wish that central banks could cut rates next year, to alleviate the pressure that, people are feeling in terms of, having to pay a lot of money for their mortgages, etc. But, that's wishful thinking. If the inflation doesn't come down below target or to target, that's not going to happen, right? And the Bank of England won't be in a position to cut rates for a while to come, simply because inflation is too high.
Yeah, and even wage inflation is showing picking up again, Sonia. But you talked about the turning point for the yen. I wonder what the turning point for the euro will be in waking up to this idea that they're not going to cut as soon as expected. George Saravalis of Deutsche Bank was on surveillance yesterday and said that the ECB should be cutting next week. He's not alone. There are a lot of people out there who think that the ECB already should have started cutting. That's pretty extreme, Sonia. What shakes people like George out of that idea?
Well, first of all, may I remind you that back in, I think it was April this year, we were discussing the fact that everyone is looking for rate cuts from the Fed this year, and we're miles away from that. So, I mean, market views flip and flop around quite a bit this year. In terms of the ECB, again, it's inflation. Look at the inflation expectation survey from this morning. People are, the 1 year inflation expectation in the Eurozone among consumers just picked up again, and it was meant to come down. It hasn't done that. It's still quite high. Inflation will pick up again as well. When you look at some of the basis effects that are going to, sort of move out of the inflation equation, we're looking for inflation rates to pick up again. And I think that very quickly is going to change the narrative. And we've seen this happen a number of times. Just, 6 weeks ago, people were talking about UST yields rising to 6%, and look where we are today. So,
Yeah, fair enough.
Steady hand seems to be the best policy here.
Sonia, we're going to have to leave it there. Why don't you get out there and enjoy the snow in Germany? Really appreciate your time. Sonia Martin of DZ Bank Manus, while we enjoy a wet and sad Christmas here in London. I could probably use a little bit of snow.
Yeah, well, the snow hasn't arrived here yet. Sonia, we'll see you soon. And sufficiently chastened, you don't want to be short euro yen. It could be sterling yen is the trade for you. We'll have more from our exclusive interview with the Saudi Energy Minister, Prince Abdulaziz bin Salman. He will be with you very shortly. He believes the 2.2 million barrels a day cuts will happen. We unfortunately showed the wrong image just a short time ago. That is officially His Royal Highness Prince Abdulaziz bin Salman.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Bloomberg Brief. I'm Manus Cranny in New York. Danny Berger alongside me in London. Oil prices, they're snapping their run of declines after the Saudi energy minister says OPEC supply cuts will be honored in full. We caught up with him in an exclusive conversation.
I honestly believe that the best decision we made was to delay the meeting. I honestly believe that the delivery of the 2.2 will happen. I honestly believe that that 2.2 million will overcome even the usual inventory build that usually happen in the first quarter. I also believe that we wanted, it's almost we were working with a checklist. And that last item, that checklist, apart from the volume and the commitment and what have you, is to give the market a signal that these 2.2 million are not going to come the 1st of April. Simply because we wanted to market to know that there will be a phased-in approach. And since we don't know what would be the market situation, be it in January, February, March, we wanted to be careful about what language we use by saying it will be phased out or gradually, and it will be based on market condition.
So I'll ask you again, what did the market not understand about the deal? You took an extra week to get there, you brought everyone on board. Mm-hmm. The market seemed underwhelmed.
Well, not the market. The commentators that wanted the market not to believe the deal did their own work. I don't want to be conspiratorial, but I believe that a lot of credibility will be going down the drain when people see the reality of the deal. We also are not worried about, the jury is still out. But again, if you talk to Aramco, if you talk to ADNOC, if you talk to many of these companies, they see demand. They see that we're getting even a better prices than what we're getting as Brent is today.
That was the Saudi Energy Minister, Prince Abdulaziz bin Salman, speaking with Will Kennedy, our commodities editor. Of course, this is about communicating to the market. Look at the market this morning, Danny. You've got a nice pump higher on the market. And the word was absolutely. These cuts can stay absolutely past the first quarter, and that is the 2.2 million that he was referring to. I mean, we've broken the 3-day losses, up 1% on NYMEX trade. Danny, good morning.
Good morning, Manis. Yes, it's really about the coherence of OPEC Plus to commit to these voluntary cuts. And on that front, we learned today, Interfax reporting that Putin is going to be visiting the UAE and Saudi tomorrow. And it's very rare for Putin to travel abroad, Manis. Since Russia invaded Ukraine, he has an arrest warrant out from him from the International Criminal Court, which makes traveling a little bit difficult.
It does indeed. I think the point of contention here, it could be really quite juicy. What if he arrives in the UAE? I mean, as you said, we were just chatting in the break, a lot of the world leaders have left the COP site. Would he travel to COP? Who's there on the ground tomorrow? I mean, this is an emboldening of Putin, as it were, really taking to international travel. Danny.
Yeah, and let us not forget that the UAE is also a home for many Russians who had fled Western sanctions. So, I mean, potentially even more a little bit awkward if Putin indeed does make his way to COP. This is Bloomberg.
cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
in destinations.
functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you think about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. China under pressure. China stocks close out the day at a one-year low as Moody's cuts China credit outlook to negative. The BOJ remains the only central bank, the major one, left with rate hike expectations, while the RBA holds and the ECB Schnabel says further hikes are unlikely. Russia President Vladimir Putin plans to visit the UAE and Saudi Arabia on Wednesday. This, as Saudi Energy Minister says OPEC supply cuts can absolutely stay past March of next year. Well, this market seems to have lost some of its mojo over the past 24 hours. We tried to rally in this American bond market, but we are unable to this morning. We're basically unchanged after we hit above 4.25% yesterday. No specific catalyst, but we did have maybe signs of exhaustion, and we had this huge deluge of corporate issuance. You got to absorb that duration, and therefore Treasuries sell off. The buying opportunity, though, perhaps, is in Europe. We're just talking to Sonia Martin, who said the market's gone too far with rate cut expectations. Maybe the move isn't to short the euro, but the euro is weakening, and German bonds, they are rallying. We're down about 3.5 basis points. We're at a May low for the 2-year yield. Also, some dovish language coming out of Australia. Schnabel was, of course, saying that they don't need to hike further, and that's the message we also got from the RBA, Manus. They held, but it was kind of interpreted as a dovish hold just because they talked about proceeding with caution. So you put all that together, Aussie continues to weaken, down 0.7 versus the dollar.
Yeah, I'm just shifting my time zones. That's sort of like 12 hours ago. And Sonia was very, very clear. She said she preferred to short sterling against the yen rather than euro against the yen. So some interesting calls from her. Now, when it comes to a market that's ramped itself by 20% so far in 2023, you maybe want to catch your breath. Of course, I'm talking about the S&P 500. JP Morgan, we're down 0.25%. JP Morgan say stocks are imperiled as a Goldilocks setup. It's unrealistic for equities going into 2024. But nonetheless, if you're invested, if you're long, and if you're long in the big broad index and the Mag 7, you're probably doing pretty well. The flip is this into the Russell 2000. You can see even though stocks fell a little bit yesterday, broke the 5-week pace on the upside, they did flip into the Russell, and the Russell is up this morning, as you can see, up over 1%. So rich valuations, will they be challenged going into 2024? We'll talk about that in a moment. MSCI Asia is down 1%. You've had this bit of a knock. I mean, it's more like a reality check from Moody's rather than anything else. They flipped on China to negative from stable, but they still maintain the A1 rating. And to that extent, it's not a shocker. There has been a continual outflow of investment capital and indeed of spec capital from China and from the Hang Seng. $1 billion worth of stock was sold today. That's not monumental, but it is just indicative of the flow show from China and from Asia. London is down 0.5%. Barclays, you thought the strategy was a winner? The Qataris didn't. It looks as if they've bailed on a major chunk of their holding. They are selling, we understand, they had a holding of 5%. They are selling almost half of their shares in Barclays, and the stock is down this morning as one of the laggards on the FTSE 100. That is not exactly what you call a ringing endorsement on the strategy of Barclays. Danny.
Manus, I'm not seeing a ringing endorsement anywhere in those equity markets. What did you do to them? Did you break them?
No, but I did divest my Middle Eastern pension fund. It's on the way to the US. Maybe that was the trigger point. Spurs are down 0.25%. I didn't do anything.
I was going to say, maybe that was the trigger point. Manus is out of the Middle East, his pension, and the Middle East, Qatar is like, all right, well, we're out of a UK stock if Manus is going to do that. But Manus, it is really remarkable. Okay, so we have the second best November in 40 years. I was just looking at some commentary from Goldman's Scott Rubner, who put out a note just moments ago saying that the everything rally last month has absolutely run out of gas right now. After all the positivity of last month, Manus, I feel like we are getting more of that. Maybe not necessarily downright, bearish commentary, but at least saying, hey, maybe this has been a bit too much.
No, all it is just the sell side trying to hedge themselves as they go into the last month of the year. It's really nothing more than that. They're all just a bit nervous now about they've gone full bull, and now they're sort of wondering, will the 70% probability of a rate cut in March come through? Let's talk about that November rally. Irrational exuberance, historic rally, what do you want to call it? December has investors getting a little bit of a reality check, questioning whether the markets really did go too far, too fast. Jay Woods, Chief Global Strategist at Freedom Capital, is with us. Did we just get over our skis?
No, when you run out of gas, you refuel, and if we're running out of gas, we're not going backwards. We're staying stationary. This is fantastic. You pull back a little bit after a nice run.
You're just selling dreams, aren't you?
No, I'm not selling dreams. I'm selling reality. The reality is we just had a great November, second best in 40 years, and we haven't really given much back. And what we're seeing is a rotation. Yeah. Small caps rallying. They still have a ways to go before we even talk about 52-week highs. Yeah, there's a lot of rotation into small caps, other sectors, and it's not the Mag 7 anymore. So you may not see the big indexes take off and explode to the upside in the near term, but long term, I still think we are on a path higher.
Jay, I'm about to pick up the phone to Goldman because that is a key flaw in their metaphor. You can indeed just refill the tank. You don't necessarily just forever run out of gas. What gets us there, though? I mean, you're pretty bullish, but what Manus and I have heard time and time again on the show is that a soft landing is priced in, and therefore there's no more juice to squeeze out. The only way is down if we do get not a soft landing, that the upside really isn't there.
Well, I think there is a little more juice to squeeze here, especially given seasonal conditions. The fact that people are going to have to chase performance as we go into the end of the year. And I look at the Russell. The Russell's been on a nice run, but it's still the laggard by far. And if you look at that chart that I just saw up there, over the last 2 years, it's been in a very wide neutral range. And, October 27th, when we bottomed, it looked like it was breaking down. It looked like the end of the world. And it held. And now we're just above the midpoint of that range. We're just clearing the 200-week moving average, and I see another 5% upside just to get to the top end of the range. I'm not saying we're going to break out and then go make new all-time highs, but just to get back to the normal range, it's another 5% upside. I'll take that.
Before we talk about the house builders in a little bit more detail, mortgage rates are at 30. The 30-year rates are at a pretty lofty premium in the 7 to 8% band. To get the bullish momentum that you're talking about, do you need the 122 basis points of cuts that the market has already priced in? Does equity market reflect the cuts that we have already juiced?
Right now, the equity market is reflecting cuts. How significant they're going to be, I don't know. I don't think this is, if we're at all-time new highs, then I'll say they're factoring in a lot more cutting than people anticipate. Okay. I don't anticipate a cut until March at the earliest, and I'd be surprised if we had one then.
Jay, just hearing one thing you said just a moment ago, you were talking about why small caps can catch up because the Mag 7 have really led this rally. Other things can now play ball here. But Amazon is one of your favorite stocks right now. Why?
It is. Well, the theme all year, what we've seen is, you know, a reversion back to the mean. If you go back to January, the first trading day of 2022, that was our high. And what we've seen in the Mag 7, 4 of them in particular, we look at NVIDIA, Microsoft, Apple, and Meta, they've gone back, they've recaptured all those gains, and then they've broken out and gone higher. One stock, actually two, Google, same way, but one stock that really looks good to me is Amazon. It has been basing, it finally broke out. This 145 level, to me, is critical. It'll pull back to 137, I think should be bought. But the tailwinds for Amazon are there. We had a strong Black Friday season. The consumer continues to be resilient. If you try to move into my neighborhood right now, you got to wig and wag through all these Amazon vans that you see everywhere. And then technically, it has a 31% upside to get to all-time highs. And given that 4 of its other magnificent 7 have done that, I think this is the one stock that can really lead going into the next year.
Yeah, but they're electric vans, so you should be grateful for that.
Yeah.
Yeah.
Well, it's good for the economy.
It's good for the environment. We've got
yeah.
COP29. Why are house builders breaking to the upside when this market has no churn, no turn? Is it all just restricted supply? I mean, maybe that's going to come unleashed if you do get rate cuts next year.
That is a great question. It is. I mean, 80%, over 80% of people like myself that have a mortgage rate at 5% or less. So I'm not looking to move anytime soon. But we just went through a crisis where mortgage rates went up the fastest they've ever gone up in history. And people have a recency bias. They see that, okay, we were at 8%, now it's just coming under 7.5%. Now let me go out and, you know, test those markets. I'm very, you know, I see that chart that we put up here. You look at home builders are breaking out now as mortgage rates just turn down. So they have that tailwind. And then if you want to look at one in particular, watch Toll Brothers today. It could be very telling. They report after the bell. The stock has already broken out to all-time highs as we head into this cycle. Any pullback looks like it could come into nice support and be bought. And their guide is going to be critical to that theory that the home builders continue to remain strong going into the next year.
Okay, Jay?
All right. You know, they have those earnings coming up in a few hours then, at the end of the day. Jay, thank you so much for joining Manus Me. It is always a pleasure to get you in your charts. Jay Woods of Freedom Capital Markets. Now, coming up on the show, Barclays drops after a top investor offloads almost half of its shares in the bank. We're going to get the details in a little bit. But Manus, how your markets doing?
Well, there's Barclays for you, down 2 1/3. Obviously, the book building has begun on that. Quick snapshot across the market. You just heard a very bullish Jay Wood there in terms of get ready for pump it a little bit higher next year. Down 0.25%. You'd hardly call that a massive pause. The dollar is flat and 10-year yields 4.24. The market now assumes 122 basis points of cuts in the United States of America in 2024. Good morning from New York and London.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Warren Buffett is somebody you've met and you know.
what does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
It's Bloomberg Brief. I'm Manus Cranny in New York, Danny Berger alongside me in London. So Nokia hit with a double-digit decline this morning. AT&T have made their choice to choose Ericsson, the rival, in a revamp of its US wireless network. Now, the project could almost total $14 billion over 5 years. The details, let's get our European reporter into this on technology. Tom Seal joins us now. I mean, this is a brutal blow, isn't it, for Nokia? Why did they choose Ericsson?
It's a massive contract. I think you can liken it a bit to the competition between Airbus and Boeing in aerospace. You've really got these 2 dominant companies that, certainly in the US, are the main players because they're not going to choose Huawei, the third one, which is Chinese. It's not going to happen. So you've got these 2 duking it out, and it's $14 billion over 5 years, as you say. Why they've chosen it? They talk about this thing called Open RAN. This is, without getting too technical, a sort of more open standard for 5G and future wireless technologies. It's supposed to be a bit more interoperable, actually allow more competition with smaller companies, but nonetheless, the existing dominant companies, Nokia, Ericsson, are acting as the sort of prime integrators, the prime vendors of this stuff. And clearly, it's a vote of confidence in Ericsson in that Open RAN standard.
Tom, just be clear, if you're going to get technical anywhere, Bloomberg TV is the home for that. It's the place where we welcome that. So, I mean, the market is obviously treating this like it is a big deal. But does Nokia have a way out of this? Or is this sort of a damage, a blow to Nokia, which it's going to be struggle to recover from?
Yeah, I think it's not the first time this has happened to Nokia, unfortunately. They lost a big 5G contract to Samsung in 2020. To Verizon, for Verizon. And so I think this is, it's damaging to that kind of momentum, that sense of, when other companies look at who they're going to use. That said, we may already be past the peak for the 5G market. 5G's already been rolled out big time across Europe, the US, and Asia. And so it's kind of positioning for the next stage of, upgrading these networks, and even, when we get there, 6G as well.
Okay, so we push forward next. Tom, thank you very much for joining us on that. That's Tom Seal. Now, another stock getting hit in the European trade, it's Barclays. Manus mentioned this earlier. It's Qatar's wealth fund offloading almost half of its shares in the lender. It's a surprise move, and it's happening as the bank's executives prepare for a strategic overhaul for early next year. Let's get more with Jenny Serrain, who leads our UK and Middle East finance coverage. Jenny, the timing's kind of awkward here. You have Barclays saying we're redoing things and Qatar saying we're not going to be as part of it as we were.
Yeah, that's exactly right. So the executives over at Barclays have already promised that they are going to deliver a new strategy come February that's meant to turn the stock around, that's meant to boost returns. And so absolutely, I think this comes as a huge surprise given, where Barclays shares are trading. There's lots of questions about why QIA would sell now as opposed to waiting for just a few months and kind of seeing how that announcement might turn around the shares here.
Do you think it'll unsettle, the rest of the market? They see an anchor investor step back. I mean, this is a bit of a blow, as you say, to the CEO and to his strategy. But, these decisions, sometimes they're strategic. What do you think it's going to do? Is it going to unsettle the strategy in any way?
No, I think they're still in the process of trying to decide exactly how they want to move forward. We've reported a lot on the types of cost cuts that are on the table for Barclays. They're also talking a lot about, maybe we'll invest more in our retail bank, or maybe we'll find different areas of the corporate and investment bank that we can really beef up. So I think everything's on the table at this stage, and I think it's just more pressure for CEO C.S. Venkatakrishnan, who has promised that he's going to unveil this new strategy. It just is one more reason why he's really got to get this right.
I mean, there's been a lot of churn on top at Barclays. Does this potentially put him under threat, or at the moment is it just the strategy he's pursuing?
I think the fact that he's already been so open about the fact that he's disappointed where their shares are trading and wants to turn things around, I think hopefully, that means we get to February and kind of see what he's able to come up with. But I do think that this just adds to further pressure with him. And you're right, the rest of the management team who's kind of been at the helm, this is not a new problem for Barclays. This has been a years-long problem. And so the fact that it's kind of gotten to this point just further shows how much is really needed to be done here.
Yeah, well, that stock is down 11.95% year to date. So he's got a little bit of work to do there. Jenny, thank you very much. Jenny Saran leads our UK and Middle East finance coverage. Coming up with Danny and myself, we're going to take some of the market-moving events for you trading day. We're building up to that jobs data, Danny. We get a little curtain raiser today.
Yeah, and maybe that'll put the mojo back in these markets, because for now, Manus, U.S. bonds are a little changed after falling yesterday. What was the catalyst? Deutsche Bank's Jim Reed says there was none. It's just the market run too far. But meanwhile, European bonds rally off the back of a more dovish Schnabel. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Tuesday, a special episode of Bloomberg Surveillance live from Apollo's headquarters. Join Tom, John, and Lisa for exclusive interviews with top leaders in finance, including Apollo's Mark Rowan and Jim Zelter, about the state of private markets, recession risk in the new year, and deal making amid high interest rates. It's all happening December 5th, starting at 6 a.m. Eastern on Bloomberg. Context changes everything.
It's a wide range. So one of the focuses of this COP, as you know, is to triple renewable capacity. So think solar and wind and battery storage, conventional, if you will, renewable technology. That's been growing exponentially around the world. It needs to keep going. We see enormous opportunities in those regards. Just again, to bring it back to Brookfield for a moment, our deployment rate is about 7 gigawatts a year. So we're growing at 7 gigawatts. We already have over 30 gigawatts in operation. We have 140 gigawatts in our backlog. We're pushing that out. With respect to the emerging world, that new fund, we call it our Catalytic Transition Fund, so it's an emerging market, developing world focus. We've identified 6 gigawatts of projects already. 1.2 gigawatts will be deployed there. But that's just one of the opportunities. The other big opportunities, you say, where's the smart money going? The smart money now is rushing towards where the emissions are. So we're thinking heavy emission sectors, if I may. You know, so that's transportation, that's chemicals, that's steel, and it's getting those emissions down because you can come in at a low valuation, you're solving a big problem, and you're having both a high financial return, but for the planet, you're having a high emissions return as well because you're getting a lot of carbon out of the atmosphere.
But is there a danger that a lot... So we also have this loss and damage fund, which is basically transferring money to emerging markets. But I was looking at numbers of onshoring in the U.S. I mean, we're talking like millions of money going into the U.S., partly because of onshoring, partly because of the Inflation Reduction Act. So how does that change things?
Yeah, well, so loss and damage is dealing with a separate issue, if I can say. It's related to climate change, but it's the impact of what's happened historically. So it's an issue of global climate justice. It's not really an investment set of issues. But as you say, there are many things happening. And with the IRA, it is attracting a lot of capital into the United States. Look, the U.S. has to get emissions down as well. And the world will benefit from what's happening in the U.S. because it's driving down the cost curve for new technologies, hydrogen, carbon capture, and storage. I mean, these are existing technologies, but they haven't been commercial at large scale. The IRA benefit in the amount of capital, and we're very involved in this, amount of capital that's being deployed is going to lower the cost of those, just like the UK did for wind technology. The whole world benefits from that, as they will with the IRA.
UN Special Envoy on Climate Action and Finance, former BOE Governor Mark Carney, speaking to Bloomberg's Francine Lacqua at COP28, where today the theme is energy and industry, fittingly. Mark Carney is also on the board of directors for Bloomberg Inc. Okay, let's get you set up for your trading day on this Tuesday. At 9:45 a.m. Eastern, we're going to get PMI data out of the U.S. That will be followed by ISM services data at 10 a.m. Can any of this data be the thing that really starts to get markets back into rally mode? 10 a.m., it is a key read on the U.S. job markets. We're going to get October JOLT numbers. Analysts are expecting a decline in new openings. Is that softening in the labor market going to have some read-through? Then after the bell, Toll Brothers are set to report. We're just speaking about this with Jay Woods. We're going to get a sense of how higher interest rates are hitting house builders. But Woods, for his part, despite the fact you've seen Toll Brothers have a very large rally today, says that there is further to go. It is the supply question, the lack of supply, rather, that is really benefiting some of these earnings in the home builder sector, regardless of what mortgages are doing. All right, speaking of earnings, some of your movers this morning, GitLab, that's higher pre-market in the pre-market trade. It's a software application firm. It had third quarter results. It all beat expectations. It also raised its forecast, so a chunky 5% rally. Tesla, however, is falling down 1%. There's a growing momentum of strikes of Tesla in the Nordic countries. First, it was Sweden. Now it is Denmark that looks set to join the strike. So Tesla shares down about 1%. In terms of your macro movers, a day of bonds, a day of a break of a rally for the U.S. bond market. But that doesn't mean the rest of this global bond market can't take the reins and run for it. Both Germany and the U.K. are rallying after Isabel Schnabel, a hawkish ECB member, said that there might not be any more need for hikes to come. That's pushing us down by 3 basis points.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
I think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
If last month's Fed meeting was really about the market had done the work for the Fed, this month's meeting is going to be about, well, the market undid all that work.
They have a perception issue with Main Street versus Wall Street and making sure that inflation expectations are anchored.
The market has a decent chance of slowing down next year. Does it mean it's a massive crash? No, not necessarily.
Our view still is for a soft landing, and I think that's the challenge for equity assets in particular.
It's not going to be all Goldilocks. It's not going to be easy, but we do think that there is a path for inflation to continue to come down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live at the Apollo. I just wanted to say that. I said that a few more times this morning. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio at Apollo Global Management Headquarters here in New York City, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Let's start with this market. Equity futures slightly negative this morning on the S&P 500. The S&P down yesterday as well. Double-digit basis point moves on Friday. Yields lower. Then Monday, yields higher. And TK seemingly on absolutely nothing.
Yeah, it's on nothing, and you give up Friday 2 days in a row that were weaker here. I think the zeitgeist out there, particularly for the fancy people, is all that money that piled in from alternative investments, CTAs as they're called, and that. And there's a huge gaming right now of, okay, that was nice. Now what? Short term. But what's it mean long term with the Fed shift and the importance of the Friday jobs report?
I'm starting to feel another narrative shift coming this way, because basically we were all of a sudden, the Fed's going to cut rates aggressively next year. This is where we were. The market was pricing that in. And yesterday people were like,
maybe took it too far.
It's, feeling a little uncomfortable. And that was sort of how I viewed the price action.
Today's all about the economic data. We'll get job openings and the ISM. TK, I'm sitting here wondering just how relevant job openings now are, given this labour market is still pretty decent, and yet inflation keeps coming down.
Yeah, I agree. This is not a jolt that's going to be that important. What I'm wondering about is this coffee so damn good.
Coffee's good, eh?
It's like
coffee's good.
Yeah, it's like
you approve.
I approve. I think that the jolt survey is less important than normal, but boy, is claims important, and onto the jobs report and the wage dynamic, Lisa, giving a disinflationary tendency there.
I love how every morning we're like, this isn't going to be important. Fed officials are going to speak, no one's going to care. We're going to hear about, what's going to happen with services. It's not a big deal. And then it is, right? And then we get a number that surprises everybody and feeds into a new narrative that was already taking place because people were pushing back against the old narrative. And all of a sudden, boom, we have something new.
Well,
and that's the way this is
services, John. China, overnight, small piece of information.
Yeah, not good.
China's services was actually pretty good versus all the balance sheet challenges that they have.
So we've got to do two things this morning, and throughout this morning here at Apollo. We've got to talk about the cycle, and we've got to talk about the industry. And a phrase you'll hear repeatedly throughout this morning, Bremo, debanking, the process of debanking and the opportunities it creates for places like this one.
The fact that a lot of bigger banks are getting out of consumer lending, they're getting out of direct lending to a lot of specific companies, particularly smaller ones. Who's going to take that place? Increasingly, private credit, private equity firms have filled that role, and it now takes on a new kind of preeminence when a lot of banks say they don't even want to be in the business.
And what's interesting, and this goes to all the management and the talent here at Apollo Global Management, basically we're 15 years on from a huge financial shock, and this entire industry was birthed out of the debris of 08 and 09.
Absolutely stacked lineup this morning. I'll go through the names for you in just a moment. Let's start with the scores in financial markets, starting with the S&P 500. Futures pulling back just a touch. Equities down yesterday, down again this morning. We're negative 1/3% on the S&P 500. Into the bond market, yields lower by just a single basis point. Can we call that stability? I think for now we can. 424 on a US 10-year. In the FX market, the euro 108.35 going absolutely nowhere. And to wrap it up, Bramo, crude 73.40. We're positive by 0.5%.
In about 4 hours, we do get the U.S. October JOLT survey, which Tom just said is not going to be important at all. I actually am watching this. We're also going to get U.S. services ISM data for November, but the JOLTS data matters when it does tick in the wrong direction. It has been bleeding lower. Job openings have been coming down. What if they go the opposite way? What if they go again in the opposite direction? Today, we'll hear from Wells Fargo CEO Charlie Scharf, Bank of America CEO Brian Moynihan, and Goldman CFO Dennis Coleman, all at the Goldman Sachs U.S. Financial Services Conference. I care about this simply because I want to hear any commentary similar to what we heard from Walmart. Are things starting to deteriorate at a rapid pace in the same kind of way, or do they still see that same stability? And there are earnings for a number of smaller companies today. And I'm actually really interested in peanut butter and jam, Smucker, but also Land's End, AutoZone, Dave & Buster's, Toll Brothers, McDonald's has its Investors Day. I could tell you're laughing at me.
Oh, because half the time I don't believe you.
That I actually care about peanut butter and jam. Well, you know, this is actually the bread and butter, forgive me, of you know, the United States. And so we're dealing with a Russell 2000. I actually didn't, but, you know, I just took a page from you yesterday. But the Russell 2000 has been underperforming. Do we see a different signal from smaller companies? That's something that actually is taking on more importance than a lot of other economic data that's been coming out.
Should we start the program? Let's start the program.
As opposed to that.
Jim Zauter joins us now, the co-president of Apollo Global Management. Jim, good morning to you.
Good morning, and welcome to Apollo.
Thank you for having us. Thank you for having us.
The coffee's good, and the price is even better, right?
The coffee's good, and the price is free, and we like that. You
that
like
works
that,
for you, right, Tom?
They have a tip jar. I couldn't believe it.
You got to put money in. Well, this is called. This is the you're making the show today from our Contrarian Cafe. So we welcome you.
Nice.
And you have a great lineup this morning. So we're excited to have you here and tell you more about our story.
That great lineup begins with you. I mentioned a little bit earlier there is a call on the cycle that we can talk about. There's also a call on the industry. Let's start with the industry. That phrase I mentioned moments ago, debanking. Perfect place to start. What is debanking, and what does it mean for you and the team?
Well, you know, I don't use that term. I really use the evolution of finance. The reality is that the last 40 years, we had amazing tailwinds with globalization and technology and lower rates. Banks they were advisors for decades. In the 90s and the 2000s, they became large global institutions. 08, 09 happens, and there's a tremendous amount of legislation, Dodd-Frank, to change their business model. But at the same time, rates were lower. And in the last 15 years, the CEOs you're going to have on today from Wells and from other places, they're focused on ROE and their shareholder return. And as they're focused on ROE and shareholder return, there's a massive gap where companies need to find capital. And firms like Apollo, we've been at the front of the parade in terms of providing capital across our business. And when you put that together with our funding model of LP capital from around the globe, plus our retirement services, we're just a very unique player in that's going on.
We've got to get into how big the addressable market is and what are private markets. Typically, we think of leveraged finance. Mark Rowan, your colleague, who we'll catch up with a little bit later this morning, talks about basically everything that's on a bank balance sheet. How big is this going to be?
You know, when most people talk about, and you did a great job right there talking about private capital and private markets, most people, when they talk about private credit today, they talk about direct origination, which is about $1.5 trillion. It's about 1/3 of the high yield and loan markets. We think the definition of private capital and private credit is around a 40 trillion number. And that would consist of, solar finance, inventory finance, trade finance, franchise finance, along with a lot of this corporate lending and investment grade privates that a lot of banks used to hold large chunks on their balance sheet. But again, in their search for ROE and appropriate returns, they're not the right place to hold that. They may be the right place to originate it, but they're certainly not the right place to hold it long term.
In our 3 hours with you, I think I want to get out of the way right away the stereotype that it's highfalutin, fancy derivatives, fancy structures, mezzanine. Everybody walks around and says mezzanine. We have mezzanine coffee, we have mezzanine Danish. But the reality is it's shockingly conservative. On your website, you lead with retirement services. How conservative, how measured, how prudent is Apollo?
Well, at the end of the day, we do not like to lose money, and that even means a penny. The reality is, if you look at our firm today, $630 billion, about $100 billion in private equity, about $100 billion in real estate and infrastructure, $400+ billion in credit. A vast, vast majority of that is investment grade. And in this year alone, whether it's Air France, Vonovia, AT&T, we're loaning money to great companies that are, a lot of them are investment grade. And it's interesting, you talk around the globe right now, in the last 6-7 weeks, buying investment grade debt of companies like Merck and Meta and many, many others, you've been making a double-digit return between the compression of spreads and otherwise. Now, that's in the public markets, but back to the private credit, to your point, we lend to large companies, mostly investment grade, and for our perspective, back to Jonathan's question, it's not a $1.5 trillion opportunity, it's really a $40 trillion opportunity.
So let's talk about where we are. You said you don't like to lose a penny, and yet you've been focused on investment grade, which has underperformed high yield. Risk has done a lot better than lower risk securities. Where are we in terms of where you can make the most money? Is it still an investment grade, despite where we are right now?
Well, it's in higher quality credit. The reality is there's still this debate, and you'll have it with Torsten later on, soft landing, hard landing, your friend Mr. Slock. But the reality is the economy is, we're sort of a little bit in this interesting Goldilocks period right now. Concern about a slowdown has been on everybody's mind the last 6-7 months. Fed's actually done a really nice job of maintaining higher rates. So I would argue that the Fed put its order back in the market right now. And the reality is you can make, as people are worrying about soft and hard landing, in credit, you've been making double-digit returns in the last 6 to 9 months.
So the Fed put us back. We can't let that go. What exactly does that mean? Does that mean that we're not going to have the same kind of credit cycle, that now you are a believer in soft landing?
I think what you're going to see is you're going to see an economy that there's going to be winners and losers, certainly like in inflation. You're seeing it right now in the goods section, goods area, where goods prices are lower but services are a bit higher. And I'm just saying, as the economy is navigating what's going on right now, the Fed has maintained a fairly high rates. The market's gotten ahead of it, if you will. And if there were any kind of challenging economic backdrop, the Fed does have a loaded gun that they can use as needed and as appropriate. I'm not assuming it's going to happen. I think you're going to see what we're all expecting. We're students of history. We expect to happen in 08 to happen again.
Right.
I don't think you're going to see that happen right now. I think the actual reality is the banking system in the U.S., the envy of the world, is actually quite robust. There are signs of the economy that are a bit more challenging. There are a lot of buyouts that have been done that will have a challenging time, but you're just going to have to navigate it with a really broad toolbox.
You mentioned the history. On an almost cultural basis, one of my themes is we had 73, 74, Pittsburgh rolled up, you and I lived it in Western New York, and the bottom line is then we had 77, a second leg of a great bull market starting into the 82 expansion. Is that the analog right now, that after the gloom of the pandemic and the churning, that there's something new here, constructive?
Well, there's no doubt in the, if you talk about those four tailwinds that I talked about, globalization, lower rates, deregulation, the fourth is technology. And there are those who know a lot more about it than I do, but they would argue that we are on the precipice with what's going on with AI, cost structure, education, and the breadth of that could have a huge impact. But the reality is the cost of capital is going to be higher for the next 5 or 7 years. We are in a higher cost of capital environment, and it's how you navigate. And back to your original question, the reality is the banking system around the globe is evolving. The U.S. is in the front of that. And as you'll hear about this morning, we think we are the player as that industry continues to evolve.
We've got to set it up for the rest of this morning. There will be people at home asking this following question, so help us answer it. Are we not just transferring the risk from banks and the risk they pose to the economy to places like this?
Well, we're actually taking the risk that was consolidated on a bunch of financial institutions and bringing it to a much, much broader system where we're diversifying that risk. Because our investors, at the end of the day, are either sovereign or other pension funds that don't own these assets on leverage, or they're other retirement services. So we're going higher quality assets, and we're diversifying the risk of the system. It's actually making the system less risky.
Jim, this was awesome. Thanks for having us.
Thank you. Well, welcome today, and we look forward to a great morning.
It's going to be fantastic. Jim's out there of Apollo Global Management. Mark Roman coming up in, I think, about an hour from now. Torsten Slock of Apollo joining us in about 15 minutes' time. TK, a lot to get into this morning.
A lot to get into, and particularly from where we are. I mean, to get into 2024 with the challenges of the bank. 2 streets over, folks, is Fortress Diamond. Did you see how tall that thing is?
It's massive.
They just topped it out. It's like massive. It's like ginormous. And here, do you know who I saw coming up?
Who'd you see?
Bobby Axelrod. He's a couple floors above this. Couldn't believe it. It's like, oh my God.
Do you watch Billions?
I'm on Billions. Yes, of course I watch Billions. We're all on Billions. Yeah, Lisa. Bram was on like every 3rd episode.
All right.
But it's coming up. But you know, it's...
You look at me. I was supposed to say something with that. Like, you really want me to comment? Let's move on.
Isn't that how this show works, Bramo?
Yeah,
you talk. That's what happens.
Okay.
You engage the camera and you make something
Thank you.
up.
I appreciate that.
All right. We'll figure it out. Equities negative on the S&P 500. Coming up very shortly in the next hour, Mark Rowan of Apollo. From New York, this is Bloomberg.
Next year, it's all going to be about these policy gaps. Which central bank is going to cut first and which one is going to lag, or is it all going to be symmetric? And the way I think we're being set up for next year is that the ECB is most likely to go first. If we look at the most recent inflation data, I would argue the ECB should actually be cutting next week.
Should, not will. The message from George Saravelos there, the global head of FX research over at Deutsche Bank. He believes this ECB should be cutting interest rates next week. Thinks the ECB will go before the Federal Reserve. We heard that from Jeff Yu of BNY Mellon last week as well. Here at Apollo, already this morning here in New York City, we've got a headline for you. Bramo reads as follows. The Fed put is back, according to Jim Zelter.
The fact that Jim Zelter was a real skeptic of Goldilocks and all of a sudden is saying, well, they've got a loaded gun in his words and they can deploy it if there is any kind of economic weakness. This is exactly what we heard earlier, and you and I both laughed. We said, no way, this is absolute, highfalutin kind of wishful thinking. Ben Laidler basically came out and he said the Fed put us back, and you and I were so skeptical, and now we hear Jim Zelter basically saying the same thing, and frankly, That's what we've seen priced into the market.
Bouncing against this is nominal GDP. John, you mentioned yesterday the importance of what we heard from George Saravelos, and you wonder what the modeled nominal GDP is for in Europe versus the United States. If you get the sub 2% GDP now and add on some form of disinflation, do we have U.S. GDP 4% or lower? And what's it in Europe as well?
I think that's the key distinction,
Tom.
It's a key distinction. Growth profile in Europe has been absolutely dreadful.
Yeah.
We thought they might be confronting stagflation in the last 12 months. They've already had a recession in certain countries in Europe. In the United States, you have to sit on this a little bit longer. We're having a conversation about the prospect of recession next year after a quarter of 5% real GDP growth, TK, and unemployment still south of 4%. That's how bizarre this moment is.
Well, again, the unemployment is a U.S. metric. Did we finally see the labor market crack again on Friday? So important. But again, I would just go to the combined animal spirit of two moving parts. One is real GDP, clearly coming down, and the other is what level of disinflation will we see, and does that set up lethargy or something, I hate the phrase soft landing, but something that we can live with? Is Jim Zeltner. I thought he had a pretty optimistic tone there.
Let's get to the scores briefly. I'll just whip through the price action for you, starting with the S&P 500. Futures coming in just a touch. Soft start to the week. We're negative here, TK, on the S&P. We're down about a third of 1%.
Very good. We are at Apollo Global Management, and what's going to be wonderful about this is the different themes that they have. Ari Jacobs is Global Head of Investments for Aon, part of what they do here at Apollo, and that is about institutional money and particularly the forefront of their retirement services. Thank you so much for joining us today, for having us here as well. There's a 5% money market fund out there. You are the wise one. What's going to happen to those flows when the 5% breaks?
Well, from an institutional investor standpoint, I think when we're looking at organizations, we think that they should be at some points agnostic about rates in some of their discussions that they're making. So when we work with our defined benefit clients and our institutional clients, they're on a glide path to help them consider what should be going on with rates.
Are you going to change the actuarial assumption? I mean, this is really the money issue for institutions right now. You have to adjust over the next 3 years your core actuarial assumption coming out of the pandemic.
So I'd say two things about it. First thing would be that we're always looking to hedge those risks in our pension plan liabilities with our clients. And in understanding that we're going to be going out and looking at that hedge, whether or not the rates are at 2%, 5%, or 8%. But what's also happening at that same time is that the equity risk premium, as we're evaluating the future, is probably narrowing a bit. So that's going to allow our clients to continue to move down their glide paths, as we call it, from an investing standpoint in defined benefit plans, and allow them to work through that as their funded statuses have been improving. So the rate part of it is relevant to us, but it's just allowing them to do more with their improved funded statuses.
Let's talk about the conversation and build on the conversation we had with Jim just moments ago. Do you see the approaches to retirement savings changing? Are we going to be shifting more into private markets in years to come?
In certain parts of the market, yes. I mean, there's no question that there's more opportunity in private markets with some of our clients. At the same time, there's a lot of discussion around the need for liquidity. So as these organizations have their pension plans continue to evolve over time, get smaller, they need that liquidity. So there's this constant balance between the look for liquidity in pension plans with the need for grabbing yields to match their liability growth. So we see a continued move towards private markets, but at the same time balancing with the liquidity needs.
Mark Rowan's going to talk about this later, but I think it's worth addressing with you first. Why do I need, as an individual, daily liquidity when I'm making a 50-year trade?
So you need daily liquidity for a few reasons. Number one, organizations at times decide to go out and settle a large percentage of their corporate liabilities with insurance companies. And when they're working through that, that liquidity becomes critical in that exercise. The insurance companies that are taking that on are seeking some of that liquidity, and we need that to make those transactions happen. Second part of it is that organizations also at times out of their pension plans pay out lump sums, where they're paying individuals a single amount based upon the way the plan rules are written, and they're going to need the liquidity for those transactions too. Those are paid out in cash.
To Tom's point, 8.5% used to be the bogey. Then all of a sudden people were like, that's not realistic. We're going to talk 7.5%. No, maybe 7% that we have to do for earnings for some of these institutional portfolios. Are we back up to 8.5% in this higher rate world?
No, I don't think we're back up to 8.5% is what we expect those returns to be at. I think that we will see the continued effort towards ensuring that you are putting that risk ahead of the return to balance out what still needs to be done with the continued effort of de-risking pension plans. So organizations are not going back to the traditional 70-30 or 60-40 type of portfolio, and they still are working towards managing their risks and therefore grabbing fixed income securities over equity producing securities to get to that 8.5%. So we're not seeing that yet.
What proportion of pensions, et cetera, are not really managing the money themselves at all, that have really just shifted to insurance companies that basically are the biggest asset managers in the world now?
So on a year-by-year basis, we've seen out of the $2 trillion or so corporate defined benefit market, somewhere in the neighborhood of $40 to $50 billion each year is going backwards. It's going to the insurance companies. So it's about 2 to 3% a year is moving in that direction. We see that trend continuing for a while. It's been out there for a couple of years and working in that regard. There's a different trend out there where organizations are outsourcing all the decisions related to their defined benefit plans and their pension plans. That continues as well. So that's a separate trend from those that are transferring to insurance companies.
I got to ask you this question. I know it's at the top of the list at Apollo Global Management. I want you to use your tough mathematics right now and tell me, should I be able to buy Bitcoin off an ETF in my retirement plan, institutional retail? Where are you on Bitcoin?
Yeah.
The whole world's watching.
This is the question
Right
I really
now,
wanted.
here it is. Where am I Bitcoin?
Yeah.
No way.
Why no way? Why no way?
You know, look, so my technical answer to that question would be, sure, have an open brokerage window and go buy whatever you want.
It's
in a defined
an,
country.
it's an abomination of the Employment Retirement Income Security Act of 1974. Period.
So I don't know if I can compete with that statement, but no, I would say that investments like that probably have better places than in your ERISA plans.
Much more diplomatic.
Jay Clayton.
That was better than Bobby Axelrod.
Jay Clayton, former SEC chair, joining us this hour, by the way.
I know.
These are questions you can ask him.
Preparing.
What do you want to ask him?
Bitcoin.
Bitcoin? Is
That's
that what you
what
want to go
everybody out
straight
there, our
off the
listeners,
top?
our viewers.
Straight to Bitcoin.
We're going to leave the next hour.
Bitcoin in your retirement plan?
I wanted to ask about Ozempic and people living longer. We've run out of time. We'll get to that another time. Ari, good to see you. Thank you, sir. Thank you. Ari Jacobs there of Aon. Thank you very much. TK, we shall talk about Bitcoin in about 30 minutes' time. And then in about 40 minutes from now, we'll catch up with Mark Rowan, the CEO of this shop, and then Torsten Slok of Apollo, chief economist, joining us in around about 5 minutes' time. TK, we need to talk about the Federal Reserve. I know we're sick to death of it. The good news is that we are in the quiet period. No Fed speak through the rest of this week until next week when we get a Fed decision.
Well, you get the Fed decision next week, but it's going to come off the decision at 8:30 on Friday. I mean, can we all agree, like, claims is a surveyed number and it'll be shocked? What if we get a sub 100 jobs? What does that do? That makes the Zelter put and to the moon.
I miss the Fed speak. I wish that we had Fed speak this week.
No, you don't.
I think that it would be really nice to have them job owning the market now in the other direction, or trying to weigh in and give nuances that people can blame them for.
What happened to Lisa? Like, where's Brammer?
She'll be back later on, you know.
Did we bring the Brammer cam on our remote here?
What did they do?
It's that camera right there. It's that camera right there. Torsten Slok of Apollo coming up next. We'll try and find Brammer from New York City. This is Bloomberg.
much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Following on X, or what used to be called Twitter. Sure. Is that a plus for your business or a minus for your business?
At worst, it's neutral, but probably no one's going to want to have a proxy contest with someone with 900,000 Twitter followers.
Live from Apollo Global Management. Good morning to you all. Let's check out the price action. From New York City, equity futures pulling back just a touch on the S&P 500. Negative here by 1/3%. Down about 0.5 on the NASDAQ. I have to say the NASDAQ's been a bit of a struggle over the last few weeks. We'll talk about that in just a moment. Let's turn to the bond market. Yesterday, again, a double-digit basis point move on a 2-year yield. I wish I could tell you why. Maybe it was Friday, we just moved aggressively lower for no real reason. Chairman Powell getting absolutely steamrolled. We'll talk about that in just a moment. On a 10-year, down a single basis point. Let's call it 424. Headline already this morning, Jim Zauter of Apollo, the co-president, TK talking up. The Fed puts back. The Fed put is back.
Well, it was with the news flow, and that's what's been missing the last 2 days. And I get there's a lot of gloom out there and reaffirmation of down we go. Some of the S&P statistics looking a little shaky, but what we're really doing is waiting for a reaffirmation of the news flow that put the put back in place last week.
Going into next week, the Federal Reserve and the ECB. Bit of a tug of war going on here. Who cuts first? I think overwhelmingly the consensus suggesting that will be the ECB. That's why the euro is facing some headwinds at the moment. The euro against the dollar shaping up as follows. 108 about 20, 108.24 at the moment. Almost totally unchanged, Lisa. Nothing new about that sometimes. Happens almost every single morning. But we have seen some price action here. Yesterday, on what we saw over the last week, I think the last week, really, just to sum it all up, euro weakness in the face of a monster move at the front end of the Treasury curve, because it's not just about the Fed in isolation, it's about the ECB, and seemingly the rate cut conversation has restarted big time over there.
The fact that Jeff Yu is saying that, yes, the ECB, he agreed, the idea that the ECB will cut first, but then saying that he sees parity between the euro and the dollar at some point next year because of what you're seeing in the weakness of the economy, in addition to potentially a greater number of rate cuts than over in the U.S.
Some big calls going into next year. That's some of the price action. Let's get you some of the top stories. Under surveillance this morning, Moody's cutting China's credit outlook to negative from stable, citing deepening concerns about the country's level of debt. The Greater saying China's usage of fiscal stimulus to support local governments and its spiraling property downturn is posing risk to the nation's economy. The government pushing back, surprise, surprise, saying it is, quote, Lisa, disappointed with Moody's decision and that the economy will be highly resilient and has large potential.
Yeah, well, I mean, no kidding. What are they going to say? Of course they're going to say that. What was interesting to me about Moody's rating decision was that they said part of the decision came from China's likelihood of offering up stimulus, and that this would erode their resilience in the face of further crises.
There's been an ultimate Beijing put for 40 years.
But it hasn't come into play to the degree that so many people thought that it would. So at this point, you've got Moody's saying that, yeah, it's going to come back into play to some degree, but that it will erode the fiscal backdrop of the country. And other people are saying it's not going to be enough.
The giant George Magnus was heated about this out on Twitter. And George said, look, this is deeply, deeply unsettling time. And the answer is they're not playing by a normal rule book, just beginning with the complete change we've seen in Hong Kong. So I think conventional analysis here, John, doesn't work.
I don't think we can emphasize enough just how wrong the consensus has been on China this year. coming into 2023, the US faced the prospect of recession and China was going to boom as they reopened the economy. Flip that upside down. China struggled big time. The economy's been a problem and the market has really underperformed relative to the United States. And Lisa, that makes you wonder what we're getting so wrong right now about the consensus going into 2024.
Well, a lot of people, including Peter Scheer yesterday, was saying he's getting bullish in China, not as a long-term play, but just simply because it's gotten beaten up so much. Enough people have said it's uninvestable. So at this point, heading into next year, do you start to see China outperform and the U.S. underperform? Basically the playbook, bring it out from last year, dust it up,
right?
Put it back out for 2024 and just say, we were right, it was just a year late.
What did Jim call the coffee bar behind us, the contrarian coffee bar?
Exactly.
Let's get to a contrarian call. JP Morgan making a bearish call on equities in 2024, saying this. Well, some of the biggest banks on Wall Street are calling for the S&P to hit fresh record highs next year. The chief global equity strategist, Dubravko Lekos-Buja, sees peril for equities as an economic slowdown is expected to pressure earnings. The bank writing, quote, the market is pricing in effectively some sort of soft landing and many are calling for Goldilocks. TK, in the view of the investment banker JP Morgan, that's unrealistic.
It's a sum total and even more confusing from a big bank. In Apollo Global Management, everyone's on the same page. I'm kidding.
No division.
No division at all at Apollo Global Management. But at these banks, you've got fractious views. And this is one view out there. I wonder where Mr. Diamond fits into the 4,200 or 4,600 or the Yardeni 5,000 view.
Here at Apollo, if anyone disagrees, they send them to the contrarian bar and say, just sit there for a while until you get on the same page. Now, honestly, to me, this is a question. We can agree with the idea that Goldilocks is a pretty narrow slot that you've got to fit through. And a lot of people are pushing back against the scenario that people are looking at. However, what does that mean in terms of stocks, which have been divorced from the economic fundamentals
this is so
in any kind of way?
unusual. I'm completely, John, divorced from paying attention to outlooks. I get it. It's a marketing thing. You know, there's like 6 slugs here at Apollo. They have to go into Mr. Zelter and they're shaking. They're physically shaking when they go in. They got to come up with estimates for the roadshow. I mean, that's what this is about.
You have the luxury of ignoring it because we follow it so closely on your behalf.
I'm humbled by how wrong I was a year ago.
Sure, I think everyone is. Right? I think most people
I'm
are.
taking a meeting after this here about triple leverage ETF.
Can you smell the bacon? I'm just so distracted by the smell of bacon.
I know, it's like protein salad.
Let's get you a mover. Shares of Nokia dropping after AT&T taps rival Ericsson for a $14 billion deal. The deal aiming to modernize AT&T's wireless network over the next 5 years. Ericsson is already responsible for about 2/3 of AT&T's US network, a significant win over Nokia, which accounts for the other third. Nokia, Lisa, getting absolutely hammered.
Which is, to me, kind of interesting because we've seen more deals recently. I just want to point this out. More deals have actually been getting done. And I understand that that's sort of a generalization from one particular deal. It's been going on for a long time. But it seems like companies are actually taking decisions that the CFOs aren't just lost in la-la uncertainty land, and they're actually making conviction calls. I find that interesting.
Alaska Air's one. Saw that in the
yes,
last
correct.
24 hours, the prospect of another deal in the Permian Basin. Maybe you get some IPOs next year and investment bankers might be happy going into 2024.
They might be happier, at least.
Happier, relatively speaking, Tom.
We are here at Apollo Global Management, and joining us now, someone you are very familiar with, Torsten Slok, of course, holding court at Deutsche Bank for years, dragged over to Apollo to provide economic wisdom, and we're thrilled that he would host us here today. Nice coffee. We're coming next week. You have one single sentence in your report. This time around, it's not the Friday jobs report. It's the Thursday, Friday jobs report, because the optimists are hanging on claims. How important are claims?
Well, that's really a critical question when it comes to this employment report on Friday for November. Jobless claims has been surprisingly resilient for a very long period now. It's beginning to look more not like a soft landing or hard landing, but more like a long-term landing. We're waiting more and more and more for any evidence of either a sharper slowdown or an acceleration. And what we do have on the labor market on the slowdown side is, as we'll get today, the JOLTS data has been showing the quits rate has been coming down, meaning the number of people who voluntarily quits their jobs has been declining. The number of job openings has been coming down. The work week has been coming down. Wages for job switchers relative to job stayers has been converging. In other words, you no longer have as much bargaining power if you change jobs. Combined with the number of people who are changing jobs for permanent reasons has also been changing. So the conclusion is we still have more and more evidence pointing in the direction of the labor market softening. One indicator, jobless claims, yes, still good. But basically everything else is pointing in the direction of what you would expect namely a weaker labor
Okay, I
demand.
want a single point non-farm payrolls estimate, but they won't serve me the bacon John was talking about. So let me go to this. Is the whisper number finally turning towards, it's a look down, what is it, John, 188,000 we're at?
That's consensus, median estimate.
Yeah, I mean,
But that
is
includes the
whisper-
UAW.
Which is about 30
But is the
something,
whisper
right?
number coming down instead of going up this time
Well,
around?
if you really back up and think about what's going on, the Fed hiked rates in March of 2022, and your textbook would tell you when you raise interest rates, you should expect to see consumption begin to slow down, capex spending begin to slow down, credit growth from the banking sector begin to slow down. And all those things are happening. And all those things should also be expected to hit, in particular, lower rated credits, smaller companies, middle market companies. And that's exactly where you're beginning to see signs of weaker labor demand. So you should expect to see non-farm payrolls over the next several months do what the Fed is expecting it to do, namely gradually be softer and softer.
Is this labour market right now, and this is a Neil Data question over at RenMac, is this labour market right now less of a reason to be hawkish at the Federal Reserve, even if we are printing 200K on payrolls?
Well, as Jim was saying earlier, the Fed put his back, because think about it. We have now a situation where the market is spending so much time on the Fed's minuscule small changes in their communication. And if the Fed is now beginning to say, well, we still don't think that we are there yet, the market says, well, okay, we are there yet, and you will come to that conclusion. But we've had that pivot so many times, and it remains to be seen whether that pivot this time is right. But the way I think we should be looking at it is in the dual mandate. Should we be focusing on inflation or employment? Inflation is moving in the right direction. Employment is moving gradually in the right direction. But if the labor market does start to have more than a soft landing, then we will certainly have a sentiment change in markets.
So I never thought that I'd get to the place where Torsten Slok and Ben Laidler would agree. I think of you as a perennial pessimist. I always open your emails that I kind of enjoy. No, I actually enjoy it.
Risks,
exactly. So you're worrying about risks, and you're pointing to all these risks.
Irresponsible.
And then you say, there's a Fed put. So does that mean that Goldilocks is back on the table?
Well, but the issue here is that the market has been interpreting the Fed in so many different ways for the last year, and the Fed pivot has come, 7 out of the last 9 times, as you will. So a variant of the old joke of how many times can you come with the same story that now is the time for the Fed to turn dovish. But they haven't turned dovish. And I think that's why we will have rates higher for longer. This is good for fixed income. This means that the front end of the curve should be still cutting coupons in terms of thinking about what is the overall outlook. It's going to take time before we get inflation under control. And I think that process, meaning into next year, still means that the downside risks to the outlook continues to be very pronounced.
Jim from Rochester, thanks so much for watching today. Torsten, I'm going to cut to the chase. There's nonlinearities out there. Along the curve that Chairman Powell looks at, where's the biggest potential nonlinearity? Is it wicked short, like Apollo short-term paper, or is it 10, 20-year French paper, 30-year 40s? Is it the Austrian piece? Where's the stress?
I would look at this from a macro perspective, that the Fed has hiked rates. We're seeing delinquency rates going up on credit cards, on auto loans, in particular for younger households.
There's a Slok Bramwell
You're also
loves.
seeing the default rates going up on high-yield loans. It's been going up quite quickly in the last 6 months. You're also seeing the bank credit growth slow down quite substantially. Taking those things together, all that so far looks like a soft landing, but again, as I said, it's more been a long landing here. But the bottom line still is, to your question, the risk is if people wake up suddenly in the next few quarters and say, wow, maybe there's more downside risk to consumption, because the hit is not only from interest rates going up. If people also start losing their jobs and the labor market soften, which is what the Fed has been talking about, we get the double whammy of both high interest rates hanging in there at the same time while the labor market finally softens, which is what the Fed has been waiting for so long.
Okay, pause, because in the last week we've just had record spending, Black Friday online, Cyber Monday.
Well, that was online.
Busiest day on record in US airports. And then buy now, pay later underpinning
is that
a lot
good
of that
news
growth.
Or bad news?
That's what I want to ask you.
Okay, so remember,
do you want to go sit by Bramwell with it?
Roughly half of the population has used buy now, pay later, and that number has just continued to go up in the last several months. So you begin to think about, well, is that a sign that they can't get credit elsewhere, even on their credit cards?
So I bought Rangers tickets with buy now, pay later.
I know. Well, you're probably part of that hat that has used it, but I'm just saying that the conclusion is that we're getting to the bottom line here, that people are getting stressed more on the household side. Savings are mainly with the middle and higher income households. Lower income households are getting more and more pressure, in particular when it comes to delinquency rates. So that's, of course, implying that we will see more downside pressure on consumers over the next several quarters.
Maybe this might be just the beginning of the consumer levering up. Why isn't it that?
Well, because the backdrop here is that the Fed is not going to cut rates anytime soon. So if the cost of financing stays high, or in Fed language, you will appreciate this, we will be above R star, which is 2.5 for a very extended period.
Where's the new R star? Come on, what do we got, 12 seconds?
We've got about a minute left.
Williams and Laubach would say they have a methodology.
Williams
2.5%.
Forget them.
So
What
the
do you
bottom
think
line,
it is?
I would go with the Fed line here and say 2.5%. And if you had 5.5, we will have restrictive monetary policy for at least a few more years. So to Jonathan's question, that means that consumers will be under pressure, potentially for a few more years.
A guy yesterday said, he was at some German bank, he said ECB is going to go first. What's a Bundesbank going to tell Lagarde when she decides to cut?
That's a real wrestle inside the ECB at the moment. But the ECB will go first. But it's very clear that different ECB governing council members are showing up at the meeting and probably having different wish lists.
Yeah, the Federal Reserve's on the same page maybe right now. I don't know about the governing council over the ECB. Right. Torsten Slok there of Apollo. Torsten, thank you. TK's got a question about retiring on Bitcoin. We're going to catch up with Jay Clayton, a former SEC chairman at Apollo, independent chair. From New York City this morning. Good morning to you all. Live from Apollo Global Management. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The reality is the economy is, we're sort of a little bit in this interesting Goldilocks period right now. Concern about a slowdown has been on everybody's mind the last 6-7 months. Fed's actually done a really nice job of maintaining higher rates. So I would argue that the Fed put its order back in the market right now.
That's the call from Jim Zelter, the co-president of Apollo Asset Management. Jim, joining us in the last hour. We're going to catch up with Mark Rowan of Apollo Global Management in around about 10 minutes' time. Look out for that conversation just around the corner. We need to start with the price action for you. The scores look like this on the S&P 500. Negative, a softer start to the week. We're down about 0.4% on the S&P. Yields coming in a couple of basis points from 423.56, about where we are this morning. In the FX market, the euro slightly negative. A weaker euro, stronger dollar. Euro dollar 108.17. We're negative on that currency pair by 0.2%. I'm not sure if this is the headline that Apollo wants this morning, but we heard it once from Jim Zelter and again from Torsten Slok. It appears, TK, the Fed put has returned.
That's been the theme here this morning, and the answer is it's based on news. And what I find fascinating is Torsten Slok's asymmetric view of the Friday jobs report, holding it up as a constructive view on claims. And if claims slip or ebb, we get the sum of his data, which is a lesser non-farm payroll.
So 180 was the median estimate for payrolls on Friday. Those estimates keep pouring in. Looking at the survey right now, TK, 189. 189. You have to bake in the UAW pop. those people
the
coming back
noise,
to
the
work,
key noise,
all of that stuff, but still, you know, basically in line with what we got in the previous
And let's
month.
not forget wage inflation as well. I mean, the heart and soul of this is somehow disinflation clicks in and even wages crack to something more reasonable. And then all of a sudden you've got, as Neil Dutta, the optimist, would say, real income growth. Income's up, and with disinflation, lesser wage inflation, that's a virtuous cycle.
Would you like a Bitcoin check?
Yeah, I think we need a Bitcoin check.
42,393 was the high of the session. So 41,671 right now.
Yeah, it's going to be interesting
Thank
to
you.
see.
That's your Bitcoin check. That's like the extent of our Bitcoin checks on this program. 42K TK in the last 24 hours. Huge move.
Pop it. I mean, you
This one,
loaded the boat
massive.
at 16,000. You look like a genius.
All this excitement about this Bitcoin ETF that might be just around the corner.
Yeah, well, I'm with Ari Jacobs, who we talked to earlier, where really maybe not. Time now for a 3-hour interview. He's dreading it. Jay Clayton joins us now. Just so you'll understand, if you grew up in a certain neck of the Appalachian Mountains, if your father worked at Hershey's Chocolate, you had the coolest father within 500 miles. That would be Mr. Clayton, who had lots of Hershey's in the kitchen at home and went on to a sterling career in law with a modest New York City law firm, chosen as SEC chairman, an eventful chairmanship, but less so than the pain and agony that Mr. Gensler is going to. He is independent chair of Apollo. How tough is it for Gary Gensler right now? How tough, you know, the battles that are going on? Do you look at it and go, that's worse than I had?
Well, look, those jobs are tough, okay? Because no matter what decisions you make, you're going to make somebody unhappy. And people who are happy never tell you thank you, but people who are unhappy say, you know, what are you doing? Yeah. And so they're not easy jobs, but you know.
Yeah, Brahma's got some adult questions. I'm going to get this out of the way right now. Gensler's dealing with this allure for some people of ETFs with Bitcoin, retail's ability to put Bitcoin in regulated entities, ETFs, funds, retirement plans, whatever. It's captured the imagination of our audience. What's your thought on this? I mean, is it a legitimate asset?
Okay, I'm not going to give you investment advice on this, but I think we're at the point where the market is going to decide over time whether Bitcoin is a legitimate asset or not. It's really not for regulators to say, you know what, that's not an asset that you should be invested in. It is an asset you should be invested in. My view is it's already in the ecosystem. Let's bring it into the ecosystem. And to your point about retirement funds, should you be putting, you know, your retirement funds in Bitcoin a substantial portion? Of course not. Of course not. We should have fiduciaries advising people around that. But it's there. It's something people want. Let's get it inside the regulated system as much as we can and have the market decide.
From when you were on the watch, I remember one day, John, on set, I looked at one full-page ad, commissions are free. Turn the page of the Wall Street Journal, commissions are free. Turn the page, commissions are free. Those kind of shops where it's cheap commissions, that's going to bring up trading of things like Bitcoin, isn't it? I mean, it's going to, you can't tell me that Bitcoin is the same as an open-end investment company wrapped around 33 and 34.
It's not, but there already are exchange-traded products, futures-based exchange-traded products for Bitcoin. Mm-hmm. So why don't we at least give people the most efficient product?
Right.
And let's try to get as much efficacy in the trading market as we can, so we understand it, so people here can have these kinds of discussions. Look, if you asked me 5 years ago, would Bitcoin be where it is today? I would have said that's a tale that I don't think we're going to see. But we're there.
Okay.
It's pretty remarkable.
Why don't you save us from? He's going to walk off the set.
Well, we're running out of time,
Tom,
Tom, so we only have about 5 more minutes left with you, Jay. So let's talk about what's happening here. So what we're seeing take place is the process of debanking, a phrase that I think Jim said he didn't like this morning, but it's a phrase a lot of people use. As places like this take on more of that business, at what point does a place like this pose the same risk as a bank and needs to be regulated as such? How close are we to that moment?
I don't think we're very close at all. First of all, I don't think we're experiencing, quote, debanking. You know, banks are and will remain at the center of our financial system. Okay, there's no doubt about it. They have the customers. They provide, you know, the vast majority of the credit. But what do places like this do? At the margins, they provide a great deal of credit. And that additional credit source that places like Apollo and others have provided, I think, has been a great stabilizing effect on the economy as we've gone through this transition. When you have more nimble credit, you have a better functioning economy.
So how many calls do you get from regulators, current regulators, that are saying, just want to check in, you still feel that way? Everything okay, copacetic?
Yes. And look, coming out of Dodd-Frank, let's just say we have a credit-based global economy. There is no doubt about it. Global credit, let's just call it 100, okay? We said coming out of Dodd-Frank globally, we're going to take the portion of that that's banking. Let's just say it was 70. We're going to shrink it. Okay. Where's that credit going to come from? If you shrink that 70 to 60, you got to get 10 from somewhere else. And I think people have stepped in, and we should recognize that's what happened.
Well, and a lot of people would say that, especially with March and what happened there, a lot of private investment firms did step in, and they took on portfolios of loans, and they helped some of those banks avoid defaulting. The question is just, we haven't been through another cycle where private credit has taken on this much of the banking sector. And so there's a question, are there stress tests? Are there things that you see sort of developing to avoid bad actors that some people say could be out there?
There's plenty of stress testing going on here, and it's the kind of question that we ask all the time. And if you look at the portfolio, the Athene portfolio, it's transparent. People can see it and the like, which is pretty. But to Jonathan's question about banking, it's not banking. We're not engaged in liquidity transformation. We're not borrowing short and lending long. You know, we have a matched duration, and that's very important. And look, regulators should ask that. They should say what is going on in this ecosystem, but it's not highly levered, and it's not liquidity transformation.
Let's talk about that word leverage. This is kind of an odd cycle where it seems like the only place that I can think of that has levered up is the US government. Where's the leverage been building elsewhere?
You know, I ask myself that question all the time. I used to sit on the FSOC, you ask about regulators. It's like, where do you have hidden leverage? Where do you have liquidity transformation? And where if you had an asset reset, are you going to have a real problem? And what is remarkable about this is as you look across the economy, the place with the increased leverage, government balance sheets. Governments have really taken on the increased leverage resulting from the fiscal stimulus.
Folkets Landau predicted that really way back at the beginning of this. He said that's where you're going to see it in 2023.
You do wonder how problematic that's going to be. Now, there might be some people screaming at the TV this morning saying commercial real estate, commercial real estate. So, commercial real estate?
You know, commercial real estate, of course, and people have looked at it. One of the interesting things about commercial real estate over time, and I don't want to be too bullish, but people have managed to work out price dislocation in commercial real estate time and time again without what I would say a cascading effect. We watch it closely. It clears.
It clears, plain and simple. There are related is rumored to have bought an SL Green property in the last 24 hours down on Madison Avenue.
And we make the mistake of, you know, we have recency bias and the like. We make the mistake of equating the home mortgage market to other markets. It's a market that's very difficult to clear.
Jay, it's good to see you. Yeah. This wasn't that painful. It's more painful when you're still the SEC chairman, I think, Tom.
Oh, yeah.
You've got to answer these questions on.
People are more interested, though.
John, you have no idea how we were in awe of people like Jay Clayton. He went in the kitchen when he was a kid and opened up a cupboard, and it was a wall of Hershey's Kisses.
Just pouring out.
Just pouring out.
Just swimming in the Hershey's bars.
I'm still recovering, Tom.
Jay, thank you.
So am I.
Jay Clayton, the former SEC chairman and Apollo independent chair. Coming up very shortly, a conversation you do not want to miss. It's Mark Rowan, the Apollo CEO. From New York City this morning, good morning. Equity's a little bit softer. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From New York City.
From London and Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is there the kind of upside?
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.